Welcome all. Today is Wednesday, September 21. Another one for the record books. That is one of my all-time favorite songs. I didn't know whether to play that or Freak Out by, was it Chic? Anyway, you guys are lucky. I did rewrite the lyrics for the song, but I didn't have time to post them. And worse, even better, you don't want to hear me sing. That's just not a good idea. But maybe I'll post them later. We'll have a lot of fun with this. Great to be back. It's been a couple weeks. I disappeared. I thank all of you for inquiries, what I'm up to. If the recently announced launch of the Nope ETF next week, if that meant I was canceling all future Twitter spaces, far from it. The Nope ETF was inspired by these spaces. So don't worry. For better or for worse, we're going to keep doing these spaces. I went off, excuse me, I went off and I rode my bike. I was in Europe and went on a backroads trip. First time I'd ever been on one. It was a lot of fun. So here we are, another day in paradise. Great room in store. A good friend and no stranger to these rooms, Tony Greer, is going to bestow his wisdom on us. And I see we've got a fantastic lineup. Oh my God, I'm looking at who we got in the room today. This is just incredible. Just take a look, ladies and gentlemen, of the lineup of speakers we have here. So this is going to be an unbelievable room. I'm feeling it. I don't want to dissect everything Jerome Powell had to say. I think Fed watching, frankly, is a waste of time. I think the Fed's almost irrelevant. They're following. They're not leading. Although my listening of it couldn't help me make me any more bearish than I was before, if that's even possible. So, the trend remains the same as far as I'm concerned. Stocks represent continue to offer return-free risk. That's my opinion. I'm sure not everyone in the room will agree with me, and by the way, I have no idea what Tony's going to say, but that's just my own 2 cents. Tony's a much better trader than I am, and our good mutual friend Tommy Thornton's in the second row. He's a much better trader than I am. I'm not adroit enough to call these zigs and zags. I just try to stay with trend. And the trend has been, pretty clear. It's funny. I look at my Twitter feed, probably when I'm feeling it, and I'm tweeting at bearish stuff. It's probably an intermediate bottom. But the flip side of it, what I really like is that I get these nasty tweets from people. They just dunk on me. The market rallies for 2 weeks after having gone down for 3 months. And they're like, hey, George, you're an idiot, blah, blah, blah. But I don't mind disagreeing, but do they have to be so profane and so nasty? Like, seriously? At any rate, I don't think some of those, and by the way, it was around mid-August when those tweets reached a crescendo, and I screenshotted some of them. So I think at the Nuremberg trials, we may retweet out a few of those things, although I'll probably be accused of trolling if I do that. Tony, you're laughing. What do you say? What do you think of Tony?
I love it, George. I love your intensity. That's all I can say. I love your intensity. I can tell you that your absence, like as a 30-something year tape reader, the absence of George Noble hits you in the head like a frying pan. So you and I don't even have to speak. But when I'm on FinTwit and you're on vacation, after a couple of hours, my spidey senses are like, where the fuck is George Noble? Like, what's going on here? You know what I mean? So that's why I reached out, and it was perfect timing. You were just getting back, and I wanted to talk about markets because I'm getting back to work after the summer. So where do you want to start, man?
Well, man, take it wherever you want. Let's just spitball and go with it. And we got a lot of smart cookies and mutual friends in the room. It's just going to be a great combo. So, Tony, bring it however you want.
All right, cool. I got today's call kind of wrong. I was expecting that a short market after this tremendously negative reaction after the CPI data on September 13th. That was a hellaciously bad day for the S&P, where we carved a new high up around 41.75, and then after FOMC data came out, after inflation came out worse than expected, we took a nosedive, and I think we're still completing that move. We saw a lot of violent selling, and we saw 6 sessions after that CPI print of, massive tick extremes on the downside. We consolidated for a few days ahead of the FOMC, and in the last 2 hours here, we dumped into a new low. So, as a tape reader, trend follower, technician, that's a bad close. It looks like we're heading for lower prices, most obviously a retest of that double bottom first from July at 37.40, and then we'll see. There's the June low below that at 36.50. But the way the tape is trading, George, it looks like we're going to be in for a lot more of the same. If you wipe Jerome Powell and the FOMC off the board today, you saw a lot of what we've been seeing, right? A dramatic new high in the dollar, to the point that people are like, oh, there's no such thing as an Icarus print for the greenback. That's cool. A new high print in yields. It seems like, as much as the Fed wants to say that they, sound like they've got it under control, I feel like the bat signal that I've been calling it, the 2-year yield, just keeps vaulting to a new high and putting pressure on them. I think that the bond market is very clearly reading the sort of political response to inflation as being wildly inflationary, and yields won't back off. And right now, I feel like commodities are sideways to higher. There's still the story where, all the markets are pretty physically tight. We've seen a big pullback after the economic, data and COVID China lockdown story of the last couple of weeks, slowing down the economy. Kind of as expected stuff, all within the ebb and flow of, these commodity markets. And right now, the BCOM is in a battle for its life on the 200-day moving average, trying to maintain an uptrend. And so, you look at the fundamentals and you see tight markets and backwardated markets, and, the continued attack on supply. And you say to yourself, how the flying flock is price going down? And you look across the pond and you hear observations from Prince Abdulaziz, from Saudi Arabia, who's noticing dramatic disconnect between the physical and paper markets, right? He sees the paper markets selling off. Meanwhile, he's raising prices every month to Asian clients. They're paying the offer. The physical markets are extremely strong. The refinery runs are strong. Refinery capacity is running at extremely high capacity. The refiners are in a great position to make money. So I'm really not as concerned about that E&P sector. But when you look at the tape today, we made new lows for the year in social media, in communication services, which is an ETF XLC, and obviously in EEM with King Dollar stomping around the tape. Emerging markets makes a new low. We see a new high in General Mills because they crushed earnings and guided higher. I think you got to be long food producers, while a lot of them are catching on fire around the country. And, commodities are just kind of offered right now. If anything, the only thing that I've seen that has given signs of a, real attempt at reversing, and it's not really that dramatic an attempt, is gold, which put in, a new low for the move and then closed above yesterday's high. And may retrace back up to 1700 or 17 and a quarter. And I'm really just spectating there. So my axe to grind is figuring out whether oil is going to hold on this dip, or if the paper markets are going to keep, selling oil off, taking the pressure off of the natural gas markets, and, kind of getting back in line. And maybe the tape readers that said, that noticed all the doom at the highs and the commodity markets are right, and we back off a little bit. Or if it's going to be that attack on supply / ESG / carbon neutral race, that everybody seems to forget about, but the long-term energy traders never forget about, or the energy investors, is that, we are so far behind, as the CEO of Saudi Aramco just said, so far behind on investment that at some point, it's kind of question of when, not if. At some point, demand is going to well outstrip supply of fossil fuels, even as we try to pivot towards the electronic platform. So that's kind of my, that's the thing that keeps me bullish in the long term on energy. I think it speaks to the fact that oil isn't backing off, in heaps and leaps and bounds, rather in dribs and drabs, because open interest is falling. There's no spec length, et cetera, et cetera. So it gives us a lot, us bulls, a lot of chances to kind of hang in there. And that's kind of my brain dump for now, George. Where do you want to start picking this apart?
So, Tony, you and I have been largely simpatico for the most part. And my hat's off to you, man. You totally nailed the energy trade. I mean, totally. And congrats for one of these perma bulls. You kind of got off the merry-go-round. I remember a little while back.
Yeah.
And I know you're in a wait-and-see mood. Could you speak to the divergence between the stocks and the commodity? Another good friend of the room. He's in here now. Michael Belkin made a great call back in mid-June to short oil, and it was brilliant. Crude's off $30 from that call. He got a lot of heat from people. But the funny thing is, the stocks initially went down like, I don't know, 15%, and then they recycled back up to a new high. And so you had this big divergence open up between the stocks and the commodity. Now we know stocks live in the future, commodities are, in the present. So when you think about how that gap could close, how do you approach that divergence? How do you think about that?
Yeah, it's a great point, George. Well, I traded accordingly. I think it's important to mention that. You know what I mean? The pullback in oil has taken me out of the commodity, and I'm talking about out of the commodity length that I bought at, at obnoxiously cheap levels in the 20s and 30s during the lockdown puke. And so that trade is over for me. Big drawdown from the highs, but a huge P&L from inception, so it's fine. And so I'm kind of trading out of the commodity, because, like you said, there's a big back off there. We're now under all the major moving averages. We've got excuse me, let me just make sure I've got the right number. We've got the 50-day crossing down through the 200-day moving average in front month crude oil. That's weighing on it technically, right? It looks pretty bad technically, like it can continue lower. And then you've got this underlying dynamic that I think is massively important in the market, where, for example, crack spreads, right? They saw their Icarus print at $60 and backed off to $30. And while that is a dramatic, 50% pullback, these refiners are used to navigating crack spreads between $5 and $15 for the most part. So their margins are puffed out. The stocks, if you look at the refineries like Marathon Petroleum, Valero, et cetera, they're kind of comfortably in an uptrend and have been so all year, right? These are the sectors that are still positive on the year and holding ground. I think that they're likely attracting some money on dips when, everybody's blowing their brains out of their technology stocks on new lows for the move and throwing in the towel on that stuff finally, and they're saying, okay, where do I, shift some of these chips around? To me, it's a kind of a, reasonable answer to say, okay, what's rallying on the year and why? And if my story agrees with that, then I want to put some flow into the ones that are up on the year, as long as they're technically intact. And if you look across the energy slash natural resources, and I'm talking about XOP, XLE, I'm talking about XME, et cetera, the pullbacks there are largely pullbacks within an uptrend. XME is trading like crap now, it's fair to say. But the fossil fuel sector are largely pullbacks within a strong uptrend, and the stocks are hanging in there because they're set up for success still, right? Their margins are wider. Their biggest risk right now is the political backdrop, right? As we know, they're likely going to tax companies in Europe to pay for inflation, et cetera, which is bizarrely inflationary and counterintuitive to me. We'll see if that gets there in the United States. I don't think it's politically palatable, but the stocks are set up on the year technically and fundamentally better than the commodities from time to time. So from time to time, they outperform. I hope that answers your question.
Listen, as Yogi, our favorite philosopher, Yogi Bear would say, predictions are difficult, especially about the future.
Yeah.
I've been very conflicted on energy. I was with Michael in mid-June. We made the call and took a lot of hits from people. Michael took a lot of hits as well, but he proved to be right on that call. We'll talk about the bond call later. That hasn't quite worked out. But the energy call, you certainly haven't missed anything. If you own the commodity, you avoided some nice losses if you stepped aside. Honestly, I don't know, and I know for me it's a multiple time frame question. I agree with you about the longer term; it's not the issue. But as our mutual friend Michael Guyat, who's just two over to your right in the upper corner, path, as he would say, path often matters more than prediction. And so my fear has been, when Michael made the call, I think crude was like 115, 120. And it was just can't happen. But you know how it is, Tony. You and I could say, we're bullish for the long term. But trust me, there comes a point where on the downside, you know this and I know this,
Mm-hmm.
you're sufficiently wrong, you just stop yourself out. So what would it take for you to, the Mike Tyson line, everyone has a plan until they get punched in the face. Okay. So you're enduring long-term bullishness on the stocks, which I share. What
Mm-hmm.
would be your uncle level, or what would you have to see for you to give up the ghost and say, you know what, forget about the long term, the long run, we're all dead. I'm out of here. Or put it another. That's too hard a question to answer. Would you
No.
be, if you had a new client coming today to you, forget about, they think you're a smart guy, you get no credit for being right for a year and a half on energy.
Yeah.
You're not penalized for overstaying your welcome. Would you be telling, if and he said I have 100 units to put to work, I want to buy energy, would you tell him to be all in on energy now or just 10%? You tell him to wait and watch? How would you be approach with new money now? What would you be doing with energy stocks?
Yeah, new money, put it this way, George, I can stick to my original thesis when coming up with a tactical trading plan for that, right? My new money thesis for energy is we have plenty of time to scale into this stuff, especially well, not even especially, let's call it for several reasons, right? Number one, it's a longer term trade, so there's no rush to get into it today, tonight, right? Tomorrow, whatever. Number three, well, sort of on the way there is with the stocks, I feel like they are going to eventually, with the way the S&P is trading, right? My thesis has been higher yields due to commodity inflation weighing on the S&P, crushing technology first and the most interest rate sensitive stocks the worst, probably natural resources the least, and sort of that's my idea. So I can hang in there with these energy stocks, seeing as they continue to really kind of outperform the S&P. But if they broke their levels and really broke trend, it would be no problem for me to sell out of those positions, right? Like right now, I've got kind of a trailing stop in XOP at around 105, below that July low that I just endured, where I was hiding under my desk, sucking my thumb for a couple of hours a day. Below the recent 65 low in XLE, you break all the trend lines down there, and these aren't far away. But I'm a tactical trader, George. So when things like that happen, I get shaken out, and I sit here with eyes wide open, saying, do I want to get back in on this trend, or is my mind changing? So
Right.
the prices where I get out are reasonably close to the market. I
Right.
don't marry this stuff.
And that's a great point, Tony. I think it's important everyone in the room understands that because everyone's got their own style, their own, the way they approach markets. The buy and hold crowd, your short-term tactical stuff, not of interest, but there are a lot of hot traders and they want to trade, weekly, monthly. And, if you access to price is at a bad local level, you can wind up looking pretty stupid pretty quickly. Tony, let me
Mhm.
just shift gears a little bit. And by the way, for those of you that don't know Tony, TG Macro, The Navigator, excellent publication. Strongly urge you to reach out to Tony. He's a must follow. And what I like about Tony, unlike some people, I don't know who that might be, like yours truly, who's dogmatic. Tony just, it's trade what you see, not what you think. Tony, guys like me, it's like we have a view, it doesn't work, and then it's like schmuck, turn the page upside down. Oh, yeah, now it looks better. See, Tony?
Yeah.
Okay, all right. But Tony,
Exactly.
seriously, I read your stuff. I can't get enough of it. I
You're the
noticed though
best.
your sheets right now. Am I right or wrong on this? You've got less on your sheets now than
Yeah.
I've seen you in the past. And good traders, like when you don't know, you just kind of pulling the sails a little bit. Am I reading this correctly? Like you have fewer positions now that you've had over the last year, or
Yeah.
what's behind that?
Yeah, you got that right, George. I think when you went on your bike ride, when you went on your little tricycle ride to Europe there, I probably had 16 positions or so on the view matrix. And I wound up, cutting all of that risk on the way down in energy and, a lot of the risk on stuff that I was, trading just because the market was giving me the chance to, trade the rebound, to trade the bounce. The time came to get out of all that stuff. I got very curious as to how the market was going to react to, the FOMC, the politics, the propaganda, the real crisis that is still brewing in Europe and not over, even though people think that the price of natural gas backed off 25% means that the European crisis is done and dusted and put away in the drawer. That is definitely not the case. So, what was my point, George?
We were talking about how good traders, and I'm accusing you of crediting you of being a good trader. When you don't know, you just shrink your balance sheet.
Oh yeah, yeah.
That
Sorry.
seems
So
to be
that
what
was
you've
yeah,
done.
yeah. So that was the point. So I got down to literally where I've got my three, sort of best performing tactical longs still staying alive. I've got those on. I was fortunate enough, knock on wood, to put a couple of shorts out into the bounce to balance my book quite a bit, or at least give the appearance that my book is, very much neutral and balanced. And I kind of made a pact to myself that I really want to do a good job as a journalist covering what I see, to be the most use to my clients and to other people. So I'm fine paring down risk right now, even though I got pancaked in the S&P today, but largely paring down risk and really trying to observe and sit here with eyes wide open. I got plenty of dry powder should a really good opportunity pop up, and I like to have it sitting there just lying around for when something good is going to fall in my lap. You know what I mean, George?
100%. I mean, I forget who coined the phrase, but they're your beliefs and there's your portfolio. You don't always have to be playing hard all the time. I know
Yeah,
I've done it too many times in my career, and I've been far worse for doing that. Sometimes when you don't know, just don't play. Get on your bike and go for a
yeah,
ride.
I love
Seriously.
it.
Yeah. So
Totally.
I said, so Tony, a couple other things. I want to go open this up. We got some really sharp guys here in the room.
Yeah,
But let's get into a free for all. So
definitely.
I look at the same things you look at. I mean, dollar breaking out. I tweeted out this morning, first thing. Dollar breaking out to a new local high. We had yields to a new high. They reversed, but doesn't matter. Just give it a few days. It's going to go back up again. But anyway, yields and the dollar to the moon. The advanced decline line's horrible. Breath is awful. I'm worried about. I mean, that's trade what you see, not what you think. If I then editorialize and start talking about, the big structure looks terrible, we haven't seen redemptions yet, people are too fully invested, seasonality's bad, God knows what's going on with the oil price. Bad joke coming up. Trigger warning. What's about to happen in Europe, I think, may redefine the term Cold War. I mean, there's just so many ways to lose here. To
Yeah.
me, the structural overlook's horrible. All right, that comes as no surprise to you because as long as we've been talking, I've been pretty negative.
Yep.
So if we were just spitballing, and I took the bear case, and we're having a debate, right? And you got to take the bull case. What would the bull case sound like? I mean, pretend, just make believe, like, or maybe you do believe it. Like, what would you do if you had to defend the bull case? What would the bull case sound like?
Man, oh man, first thing I would say is turn your screen off and don't look at the chart. Okay, you're not allowed to look at the chart because the price action has been literally so confirming that last rally that we was just saw was nothing but a retracement rally, and that we're about to knife lower. So anyway, what's the bull case?
All right,
It's tough
that's
to
what.
it. Yeah,
Sorry, if
it's
you don't
well,
if you, if
no,
you
no,
don't want
no.
to answer, I can ask you an easier question.
No, no, no. I want to come up with it. You have
Go
to
on.
figure out what it is. It's hard to come up with a bull case other than, maybe a pivot to hard assets is going to be something that, the stock market can muster. We haven't broken, broadly speaking, the broadest uptrend, and, maybe you can hang your hat on that and buy a dip. But man, it's hard to make a case for, looking for performance in terms of, trading or investing in the S&P to the upside. Really hard for me for the rest of the year, and maybe even longer than that, George,
All
to
right,
be honest.
my last question. Then we're going to go to Mark Newman, and then we're going to go to Michael Guyad. So Newman on deck, Guyad in the hole. So Tony, you can do anything. You can be long, short, spread trade, whatever you want. I mean, obviously, you don't have a tremendous amount of conviction. If you did, your
Yeah.
sheets would be bigger.
Yep.
Do you have any? What are your high? Do you have any highest conviction, super high conviction traders? Let me put it another way. Regardless of your view, what I always like question I always ask myself, like to ask others, is what's your conviction level? 1 to 10, 10
Mm-hmm.
being the highest. All right. So
Mm-hmm.
when your conviction's at 10 level, you're willing to get in there. The counts, it's 3-0. The pitcher's got to kind of come in with it, and you're willing to dig in and swing for the fences. All right. Other times, the guy's throwing heat, and it's like, what the hell? Forget it. I'll be lucky if I get my bat on the ball. So, like
Yeah.
right now, like, do you have any really strong? What's your strongest conviction? Do you have any strong conviction, or it's perfectly good to say, you know what? I just don't know. It's too confusing right now.
Yeah, George, the one thing, when I look at my view matrix, I can say that like two positions jump out at me with that give me a lot of conviction to stay in them no matter what. What's funny is that one's long and one's short, right? I don't want to go into the Marathon Petroleum refiner trade because that trade is working, has been working. It's like kind of all systems go. Leave that where it is. When I look at the short side, I look at the home builders, and I'm like, 8 ways through Sunday, I can't figure out how the stocks are going to survive the year. You know what I mean? Like, this is a sector that is, you sort of got it right where you want it. Rates are rising. It's working against the consumer. It's working against, the mortgage markets. Um, XHB has been behaving perfectly as a, complete reversal of its rally. It just saw its finest days after the lockdown when everybody was, moving to a new city, redesigning their workspace, this and that. And so my kind of thesis is that if XHB gets back below the 2020 lows, which were kind of, we bounced off of in June, bounced off of to the 200-day moving average, where I tactically put on the short. And I'm pretty confident that as yields prove me right, that they're going higher, that XHB is dead, right? It's off 34% on the year. It's in bear market territory. It's checking every technical box that you need. If you want to tune into the earnings of Pulte Homes and Lennar, they're all getting crushed by, number one, inflationary commodity costs, and number two, clients walking out the door because they couldn't get a hold of the mortgage rate they were looking for. So that's kind of the theme across the nail banger sector. And then in retail side of XHB, the consumer is going to have, difficulty navigating a higher yield and higher inflation market as well. So I feel like that takes, discretionary spending out of their pockets. So I'm short home builders, and below the 2020 highs of like 50, which is the same as this year's low, I would double my bet and look for that thing to really come apart. I'm just bearish as hell that sector right now.
Awesome. All right, it's time. So we got Newman stepping up to the plate and Guides on deck. Hey, Mark, what's up, man? Mark Newman?
Hey, George. Hey, everybody. How's it going? A couple things real quick. I'll just hit on three quick points. One is Fed related. So I was chatting with a big guy the other night, and we were talking about what's going on in Japan, right? And the Japanese, the BOJ owns the Japanese market. Like, that's pretty clear. The ECB is trying to contain the the EU, whether they can or not. And with the Fed, someone had riffed that the Fed was the market, and we were discussing how the Fed, the U.S. market is just too big, and the dollar's just too big for the Fed really to control the market like Japan and the BOJ. So that's one clear distinction between the three central banks of importance. The second point I wanted to make was about oil. It feels to me like there's a political favors, quid pro quo, keeping oil low before the midterms. And I think into October, or maybe sooner after that in the elections are cleared up, I think oil maybe resumes. That's a maybe. I don't know. The biggest point I want to make is this, and it's about positioning. And y'all maybe don't know. I don't know. I'm working on this ESG orphans, and it's really a under-owned sector. And the reason why I bring it up is because I did a lot of work recently. The Spider's top 5 holdings: Apple, Microsoft, Amazon, Tesla, Google, 21% weighting. The QQQ, same 5, 42%. Now, I looked at ESGU and ESGV, BlackRock's flagship ESG fund, and Vanguard's. Do you want to guess what those top 5 holdings are? They're the exact same at about 21, 22%. So last Tuesday, a week ago, right, we had the Qs down about 5.5. We had the SPOOs down about 4.5, and we had those 2 ESG funds down about 4.5. So what happens is this is massively over-owned by everybody. And then the other day, Citigroup said we need to overweight info tech because the 18% to 36% weighting in the S&P wasn't enough over the last decade. And then you have the quants. They're all long to the gills. And today, Mr. Powell confirmed that rates are not going down anytime soon. So now everybody in their market exposure, do you want small, medium, or large tech exposure? And now we're heading into fiscal year end for mutual funds into October, and the tax loss selling season is going to be here. So I would say the biggest risk to this market by a long shot is this big tech space. The Apple, Microsoft, and Amazon short interest is under 1% in all of them. So I believe that's why Apple at 7% of the SPOOs at 25 times forward. Is there anyone not long Apple out there other than me? I don't know. But the problem we have here is that everyone is rooting for that big tech space. And I think that is where the big risk is going in the fourth quarter.
Newman, as those political commercials will say, my name is George Noble, and I approve of this message. More power to you, brother. So Newman, you're spot on. Just stay there because this is going to get to be fun. All right, so we're going to do Guyad, followed by Michael Howell, followed by Tom Thornton. Mr. Guyad, how are you, my friend?
I mean, not too bad, considering finally I got the right kind of action in Treasuries. So first of all, Tony, your XHB home builders is my LBS1, which is lumber. And it's not a coincidence that when you see home builders weak, lumber tends to be weak because, as I keep saying, as I just presented at the local CFA chapter here in Grand Rapids, Michigan, lumber is about housing. We all see it, we live in it, right? So, and lumber has been weak pretty much the entire year, just like utilities have been strong the entire year. I've talked about this point before. The frustration in my world from a risk-on, risk-off perspective is that The signals that I follow in the funds that I run have been risk off. Utilities have been strong. That's defense. Lumber's been weak. That's defense. Now, I shared in the nest a bit earlier this idea, which I keep saying, that if you're entering a highly volatile period for equities, the question everybody has to then think through is, well, how do you play higher volatility for equities? Risk off is ultimately about conditions that favor higher volatility. How do you play higher volatility in equities? Historically, there's only three real risk off plays that benefit from stock market volatility. Not my opinion. You can go to the data and look at this. When you're in high volatility regimes for stocks, the three best ways to play that volatility are long duration treasuries, followed by gold, followed by the dollar. Historically, of those three, long duration treasuries, not an opinion, are the best way to play risk off, except this year, where it's been utter hell. The worst of the three, the drawdown in long duration treasuries, is larger than the drawdown in equities. The interaction of the drawdown in treasuries to equities in the drawdown is something we've never seen before in history. Now, let's play it out. Let's say we're resuming a risk off period where this time around the concern ends up not being about inflation, but about default risk, right? Because I keep going back to, why are treasuries the best risk off play? Because it's about default risk off. Credit spreads widen, money flows into the quote unquote safety of government debt, because the reality is the government owns our assets through taxation, not us, right? So that's why you see that movement in the long end. I think today, I think really actually last Tuesday is when the regime started shifting. Today is a good example of the point that this narrative that the Fed hiking rates is not good for long bonds. Today proves that that's not the case. Long duration treasuries were the only thing, one of the few things that were actually made money as yields fell on the long end. And I keep making this point. The Fed does not control the long end of the curve. So everyone, I think, should ask themselves very simply this question. If you go with me, based on history, based on the data, based on the quant work, that your three risk-off plays are long duration treasuries, gold, and the dollar, which of those looks the most undervalued? It's not the dollar. It's not really gold. So if finally the regime is shifting, if now we get into a classic risk-off moment, okay, fine. You can have the short end rates rise to the point of others here saying that rates will keep rising, but it's always a question of which rates. The rates that probably are rising will be, or that were likely to rise, will be short rates because the Fed controls that. Junk rates, which means credit spread widening, and if that's the case, the rates that will be falling would be the long side of the duration angle. I desperately need that. I mean, the shit that I've gone through this year, I've talked about this ad nauseum. I have three funds, they're rules-based. They all suck this year, unfortunately, because they all use treasuries as the risk-off play in high volatility based on historical relationships, even in the 70s. If this anomaly is over, which I hope to God it is, this sequence interaction of stocks to treasuries, then that becomes really interesting because it would suggest you're entering a classic risk-off period with stocks already quite a bit off the highs, which means conceivably you could have some real pain to come. I don't know, right? It's not impossible, but it seems plausible to me that this could be the first step to some degree of normalization in intermarket relationships as high inflation still remains with us.
Thanks, Michael. Much appreciated. Okay, so now we got Michael followed by Michael. So we need Michael Cantron, so we got the triple play here. Mr. Howell from London. Wow, you're up late, my friend. Great to hear you, Michael. And then Tom Thornton on deck. Michael, what's going on? Haven't spoken for a bit. My hat's off to you. You totally nailed this. You've got us into a fine mess, my friend. And you've become quite a Twitter celebrity. I know you've got quite a big following going on now, and people always love to hear your views. So, Mr. Howell, you want to give us a little night music from London? What's going on, my friend? Michael, are you there? We can't hear you.
Can you hear me now?
Hi, yeah, you're George. Good. Yep. Hi, Michael. Hey.
Great. Hi, everybody. I'm going to say something about the fixed income markets because I agree with Michael Guyot that it's kind of the elephant in the room here. But I want to focus on something which is a little bit wonkish, but it's still very important. And that is that if you look at the US Treasury market, the term premium on the 10-year bond is at an all-time low, okay, on our estimates, but actually also pretty similar figures from the numbers that the New York Fed put out. That number is screaming at us. That's what the Fed ought to be looking at and asking the question, Why is this number printing so low and so negative? It's a big, big warning sign. And let me just give a heads up as to what it means.
Yeah, Mike, let me interrupt for 1 second. Maybe for the benefit of those in the room, I think we've got a huge room here. You could just give idiot's guide to what term premium means, perhaps.
Yeah, okay. The bond can be split into two components. One of those is the expectation of policy rates, okay? What the Fed is going to raise the Fed funds rate to. The other component is basically a premium or a discount, which takes into account interest rate risk if you're holding duration. So it tends to be moved by supply and demand factors rather than rate expectations. So think of it as an extra bit on top of expectations of rates, and it can trade at a premium or a discount, but it has huge information in it. It's one of the most valuable pieces of information in the entire financial market. That is trading at an all-time low. And what it's telling us is one of three things, okay? One is that the fixed income markets are discounting a huge recession. Well, that may be right, but the equity market's not. The second thing it could be telling us is there's a structural shortage of collateral in the system. Well, we kind of suspect that after years of austerity policies and Fed QE, there must be some shortages. Or the third reason is that there's this basically a huge liquidity squeeze. Well, we know that. Our data tells us that. It tells us that if you look at global liquidity on our index, which is a 0-100 range, we're down at 17. It's really at a low figure. Now, the corollary of this is if you use that term premia to extrapolate US earnings, in other words, S&P earnings for 23, it's a minus 20 print. And analysts are still out there at plus 8. There's a huge gap to fill. The bond markets are on a very, very different page. And what's more, the term premium is telling us that there's a lot of shit out there that's going to hit the fan.
Hey, Mike, can I ask you a quick question? Because I have this it's not really a conspiracy theory, but I have this belief that the Fed probably desperately wants to see real risk off behavior take place, meaning money flow into treasuries, so that they can sell into that demand. In other words, historically, when you have higher volatility in equities, long duration yields fall, there's a demand for that flight to safety in treasuries. Again, that's the risk off trade historically. They want to roll off the balance sheet. They want to sell treasuries. They can't do that if yields keep rising without causing an outright depression. So they've got to some extent, sell into new demand, which means they probably need to see stocks go down and then that flight to safety behavior come in and replace them.
Yeah, I think that makes complete sense to me. Yeah, absolutely. There's a trillion of new treasuries to sell, and the Federal Reserve is probably aiming at $500 billion a year. So there's a lot of supply coming out. That's for sure. But you know that's another factor in a recession. The demand for treasury will go up, big time. And I don't know of many funds that are overweight treasuries right now.
So Michael Howell, just continue with that. So, and again, Michael Howell must follow cross-border capital. Michael, you've been, and I'll say it again, and you're not paying me to say this or otherwise. You alone, I'm going to embarrass you. I remember visiting you October last year in London, almost a year ago, and you were already banging the drum then. And as I've tweeted at many times, not only were you right, but you were right for the right reasons. You called this liquidity thing. And so, no pressure here. It's hard to kind of outdo what you've done. You've been on a real roll here the last year. But where are we in this continuum? You think? I mean, I know you've been tweeting out and asking a leading question here. You've been positing that 3,000 S&P is in our is in our future perhaps. But give us a framework for where do you think the market could go to, and how do you get there?
Well, I think the answer is, I mean, there's a chart we put out on our Twitter feed pretty much every week, which is mapping Federal Reserve liquidity injections into money markets alongside the SPX, and it's tracking, remarkably closely. If the Federal Reserve is believed in what they want to do, to take another trillion or trillion and a half out of the balance sheet, you're talking about an SPX trading around 3,000, possibly 3,200, but somewhere in that range. So there's a big drop yet. If they make an error, which is entirely possible, and the error could be that they allow reverse repos to jump and that's a concern internally in the Fed as well. You could be seeing, way south of 3,000 on the S&P. So the outlook's not great. Now, probably the U.S. market looks one of the better ones worldwide. I can't believe why anyone wants to buy the Eurozone markets at the moment. These things look even worse. But basically, we're on the Fed page right now, and the market in the US does not look good for all these reasons. But the bond markets are there, screaming at us that there's a big problem there. And I would just urge everyone, including people at the Fed, to look at what the term premium are telling us. These are abnormal prints, all-time lows, 60-year lows in term premium, and that's telling us that there's huge excess demand being built up in the Treasury market.
So, Michael Howell, just listening to you crosses my mind. It seems that if one wanted sort of a high conviction trade, high Sharpe ratio, sounds like, I'm not sure what words in your mouth. This is the wrong trade, and you tell me what is the right trade. Sounds like you'd be very and Guy, don't speak up. You didn't ask me to ask this question, but I'm going to pour gasoline on your fire. Being long of bonds versus short of equities, Michael Howell, it sounds like you would very much like that trade, correct?
Yeah, I think I would like that trade. I think I would tend to be nearer the front end of the curve right now, and the reason for that is not because bonds would probably try and rally in a recession. The trouble is there's a huge amount of supply out there, and you're not getting a lot of demand coming in from foreigners. A lot of that is already been satisfied, and we know the Chinese are not buying anymore. So that's been a major element in the last few years. Therefore, I would tend to say, you want to be nearer the front end, probably mid-duration. I'm not so convinced that the long end will rally a lot. It should do, but I'm not convinced by that.
And Michael, one other question, because you've got a very global perspective. Most of us in the room are more insular than you are. We're Americans, of course. You mentioned the euro and what's going on there, and then there's of course Japan. So maybe just a word, tease out a little bit further your view on sort of the euro, the European economy, the yen, and the Japanese economy. Because again, currencies is all a relative thing. And so, I remember the last time we spoke, you were rattling on about the Japanese. In the end, it's continuing to grind lower or higher. So what are your thoughts about where we are? You mentioned, as I recall, I thought you said the euro might go to 85, possibly, whatever. But what are sort of your updated views on the eurozone, European economy, currency, and same thing for Japan?
Okay, well, on the euro, I still hold to the view that the euro is vulnerable to a major sell-off, and I still hold to that. The reason being is that the anti-fragmentation policy of the ECB, which is basically trying to stop yield spreads across the EU countries from blowing out vis-a-vis the German Bund, that policy requires more liquidity. They've already basically stepped up to the plate. One of the things that they slipped into the monetary policy announcement last week when they hiked rates by 75 basis points is that they allowed banks to basically hold on to their special loans that they'd taken out from the ECB during the COVID crisis. So in other words, what it means is the ECB balance sheet is not going to be run off anything like as fast as first slated. It's going to be bloated for some time. And that, I think, puts a lot of downward pressure on the euro, particularly if the Fed is squeezing the balance sheet in the US. So that's number one. From a European stock point of view, that maybe is a little bit of a palliative in the sense that you've got a weaker currency to help. In terms of Japan, I think we're very close to the stage where the BOJ actually starts to tighten monetary policy. You can't see a currency collapse at this rate and just be nonchalant towards it. I think there's been, although this sounds like a conspiracy theory, I probably aired this before, George, on your Twitter Spaces, is that in the period from early March to early May, the yen fell at an annualized rate of 82%. In all my years in financial markets, I've never seen markets do that to a currency. Only governments do that. There must be something behind it. I think the yen was a stalking horse. I think it was a stalking horse to basically hit the Chinese. I think the dollar has been weaponized, and what the U.S. Treasury was trying to do was basically to push the yuan through 7, which they probably succeeded in doing. The Chinese have been trying to hold that back. They've been tightening monetary policy through much of the last 9 months. That's why one of the reasons the Chinese economy is so weak. There's no sign that they're changing that now, but I would suspect, since they've allowed the yuan to devalue, they've finally sort of thrown in the towel. I would suspect that we're probably weeks or months away from a major easing in China, because they've got to do that, and it may coincide with what's going on in the October 20th Party Congress when Xi Jinping gets re-elected. That would be bullish for commodity markets.
Right. Okay. So,
hey, George, can I add one thing on Japan?
Yeah, just quickly.
One
Newman,
thing on Japan. So October 1st, they're going to start passing much more costs on to the consumer. And basically, the CPI in Japan, which is down around 2.6 last reading, is probably going to double in the next month and a half. And you got Kuroda still buying JGBs. Last night, 1 trillion yen. So I think that the QE FUBAR that is Japan is coming to a head quickly. I'll add it. That's it.
Wow. All right. So let's just reset here for 1 second. So I think Michael Guyad has a quick follow-up for Michael Howell. Then Michael Guyad, after your question, we're going to Tom Thornton and then Doomberg. Michael Guyad, do you have a follow-up for Michael Howell?
Yeah, real quick, because on that euro further sell-off, and I've been bringing this idea up quite a bit the last several months, and I'm increasingly of the mindset that this is likely to happen, which is there seems to be a looming sovereign debt default crisis that's coming, which you can argue the Fed maybe wants. I always go back to that point that inflation's a process, deflation is an event. And one way to get liquidity out of the system is if you have some kind of foreign entity or Asian contagion equivalent happen. Michael, you brought up that point that you haven't seen foreign demand for treasuries. What's the likelihood that changes if the dollar keeps on rising like this?
Well, when I said I haven't seen foreign demand for treasuries, what I was trying to say was that there hasn't been a lot of Chinese demand recently,
Fair,
but there has been foreign demand that's been going in, and a lot of that has been basically the US dollar, US Treasury market is clearly a safe asset for a lot of foreigners. That's for sure, much better than their domestic instruments. So I think that the ultimate problem with the eurozone is there's no safe asset. The only safe asset in the eurozone is basically the German Bund. That's not a euro security. It's a German security, and that's basically why the whole thing is flawed.
Awesome. Okay. Excuse me. We now turn to our good friend, Mr. Thornton, and then to be followed by Doomberg. And after Doomberg, we've got Jeff Garbacz. Tommy, good to see you. What's up, my friend?
Hey, George. Welcome back from Italy. I wish I could have joined you on your bike trip. That sounded great. I stayed here watching the markets do their thing, and it's been quite the September so far, quite the year, actually. So, the bond market, I get a lot of questions of, when do you buy, when you buy the 2-year, when, honestly, it just, there's been very few signals that on my part that I could say that it's there. Market sentiment on bonds is really, really low. On the DSI, Daily Sentiment Index data that we put charts on, it's been at like 10%. Today's probably a little lower, maybe not that much, but I'm more of a equity guy, and I will tell you that there's a couple things that are concerning to me. First of all, I'll say that I have been scaling out of shorts on this down move. I've been in the belief that we would go lower. I'm becoming more at the belief that we will break the June lows. We're less than 4% with the S&P from the June lows, and about 4.5% for the Nasdaq. That could happen really, really fast. Partly because I think there's a couple issues. One, market sentiment on the S&P is at 8% bulls. Now, market sentiment is not, it's a condition, it's not a trigger. But when I start to see things get under 10%, we've seen, I think, about 4 times this year where we hit 10% and we saw bounces. In June, we hit 7% and we bounced. But here's my problem. I follow DeMark indicators, and they've been absolutely spot on this year. Really, really solid. The DeMark indicators have DeMark sequentials, which is those are if you look at my charts online, they're the red numbers that go to 13. And just about every index and a ton of various stocks, including all the mega caps, have that day on day 7 of 13 or day 9. Even in some of the European indices, the Euro Stock 600, the Euro Stox 50, those are on day 9 of 13. So the problem I have is market sentiment is very, very low. And when you're charted, you can see where things tend to bottom out and when you start to see things. But those sequential 13s need to trigger as far as a buy signal for me to where I want to be buying a bounce. So I'm scaling out of shorts. I took off some SPYs and Qs today. I've the largest cash position ever for the trade ideas sheet. But here's the other part. The Fed's not going to stop. They just made that very clear. They have a meeting the week before. Their next meeting's the week before the election. And God knows there's going to be one party that's going to be very upset with the Fed, which that's, I'm not getting into politics here. Retail has not capitulated, and the Bank of America fund manager survey stuff, and actually, the flows have continued to show retail is buying the dips. And a lot of that will be like 401k type money that goes in, but retail has not capitulated, and I think that's a big deal. You've also had earnings blowups. I think FedEx was just absolutely devastating, and one of the ones that you don't want to see if you're a macro person, because FedEx has so many different tentacles in so many different places, from consumer demand to business. It was devastating. And I think that we're at risk now for more earnings surprises. And as you see, the market doesn't really take too well to those earnings surprises. So we're in a really tricky period right now. And I put out a note the other day, and I basically called it chart doom. And I don't like to be, hysterical about, like some people that, the end of the world's coming. But I do have a price target on the S&P, and it's based off of one of the DeMark, it's a variant of a Fibonacci retracement. S&P 2962, and that's a 0.618 retracement off the highs. Now, the problem I have, and some people will say, oh, that's crazy. Well, back in other periods, let's say in 2020, if I had said that 2100 would be the target, you probably wouldn't have thought that could ever come true, and we were within 100 points on the S&P. In 2008, we not only achieved that, but we went much lower. That was at 959, and we went to 666, right? So we went even further. In the tech bubble, it was at 943 after being over 1500 on the S&P, and we went even lower to 763. So this is not based off of like some pie in the sky type of theory, but it's something that's happened in the past. So my view is that this could be rather slippery into Q3 earnings, and I've talked about it with you, George. This reminds me of Q3 in 2000, when a lot of the companies had to give up, and they were at the confessional telling everybody how crappy their numbers were going to be. And a lot of those companies were big tech companies. Apple went down 50% in Q3, Q4. And I mean, it's a different company, obviously, now. But I think people have to understand that there are a lot of people trapped long in a lot of stocks. And if this thing breaks, don't be surprised if it really breaks hard. And I'm not going to use the the word, well, I'll say it could crash. But I'm not positioned for a crash. I don't like to position for a crash. I don't recommend people go out and buy out of the money puts or do something silly with a lot of their money, because this is the time where you need to just preserve capital and get through this and look for places where we get bounces and, rinse, repeat, and keep doing it.
100%, Tommy. Really well said. And yes, shorting is for professionals, but at a minimum, preserving capital, like you said, holding cash, so you're not getting margin called, the market tanks. So you've got a balance sheet to be able to redeploy capital when the market finally gets washed out. I mean, I just see so many ways to lose, and a very high probability that we're going to lose, and so few ways to win, and a low probability that we're going to win. Talk about the market going up or down. But to me, look, there's no guarantees in life. The risk reward setup to me just looks horrendous, and so I'll put it another way. I have no sympathy for anybody who loses money being long in this market. You don't want to be short, fine, but being long, you got to be out of your mind. Thanks for that, Tommy. All right, let's keep moving here. We're going to do Doomberg, and then we've got Jeff Garbacz on deck, and KFAB in the hole. And after KFAB, we've got Amy. So Doomberg, good to see you. What's up, my friend?
George, how are you? Really amazing space, and a real honor to be part of it. Thank you for inviting me up to speak. I have 3 points to make to add to the discussion, and I agree with a lot of it since I've been listening here. And you caught us at a good time. We have our monthly webinar for our Pro Tier tomorrow, so we spent the last 2 or 3 days with our heads down, getting ready for a presentation we're giving that gives an overview of the global energy markets and what's going on in that space. So the first big aha from that research and putting together that talk is we have this mechanism internally to normalize the primary energy prices you see on your Bloomberg screen, so that you can directly compare coal to oil to gas to pick your favorite primary energy source. And the way we do that is we correct for currency, we correct for units of trade, and we correct for inherent energy embedded in fuels. So, for example, there's 24 million BTUs in a ton of coal, and there's 5.8 million BTUs in a barrel of oil. And so when you put it all on the same page and you just read across the different primary inputs, there's a really fascinating situation in the market today that we think is telling us a very important signal, and that is this. Coal, on a dollars per million BTU basis, is more expensive than oil today. And that's almost unprecedented.
Wait. Mic drop. I don't think I heard you correctly, Doomberg. So you're going to have to say it again. I'm pulling.
Yeah.
Could you say it again slowly, please?
Yes. So if you normalize for how much energy is in a ton of coal versus how much energy is in a barrel of oil, and you plot them all on the same chart in dollars per million BTU, the price of Newcastle coal is higher than the price of WTI oil, which is the second most remarkable thing we find when we look across the energy landscape today. So what does that mean? What could that mean? To us, that means that we're entering a period of stagflation, significant recession with inflation coming with it. Why is that? Coal is a lump of rock that can only be burned. And the desperate need for primary energy means that people prefer coal right now for a very important reason, which is you can just pile it next to your coal-fired power plant. It has no storage costs. Train load after train load could just dump it into a giant pile. And then you can secure your very basic base of Maslow's pyramid need to make sure that the lights stay on for your population. Oil can also be burned, but also has substantial, refining and up value potential. Like you can make chemicals from it. You can refine it into diesel, into gasoline. And the fact that dirty, rotten, high CO2 coal is today more valuable than WTI, corrected for units of trade and energy content, tells us something, and we believe tells us something meaningful. The second conclusion that we're going to make tomorrow is we look for confirmation of this insight. And we look no further than the disparity, the shocking historic disparity between coking coal and thermal coal. So what are those two types of coals? Thermal coal is the coal I just quoted, and that we said is more valuable than oil. The only thing you can do with thermal coal is burn it for heat, and then you boil water and spin a turbine and make electricity. Coking coal is a premium version of coal, and coking coal is used to make steel. Historically, until very recently, coking coal has always sold at a premium to thermal coal. And why is that? Well, it's got lower sulfur content. It's got higher BTU values. It's a premium coal. It requires extra refining in its processing. When you mine for it, you have a few extra steps in the factory before you load it onto the train and send it from Canada or Australia or Indonesia, and you send it to China or India or Vietnam. Pick your favorite manufacturing center. The coking coal is always sold at a premium to thermal coal, and today you can't give away coking coal, and thermal coal is through the roof. And this is despite the fact that we believe, although the market seems to be proving us wrong, that many thermal coal fired power plants could in fact use coking coal. It's selling at $100 to $150 a ton discount, depending on which grade that you look at and which market you look at, to thermal coal, which again is another bizarre, really insane market signal that must mean something. And to us, again, we think it means the desperate bid for primary is going to be way more important to the incremental economy than the value-added manufacturing sector. And then the last point that I would leave you with before giving you back is, once again, as I think Tony mentioned earlier, Dutch CTF is off 50% from the blow-off top at $100 per million BTU. The spread still between the U.S. natural gas and, in particular, Canadian natural gas versus, basically LNG pricing going into Europe and Asia it's astronomical. It's off the charts. And so we're very interested in any manufacturer that is based in the U.S. that has natural gas as a primary input and for which their products are priced globally. If you look at fertilizer players, the global price for fertilizer is creeping back up near the all-time highs from the sort of July timeframe. Those people will be printing a shit ton of cash. Whether or not that cash is reflected in their current stock price is beyond me. But there are going to be companies for whom playing the spread in natural gas is going to be an epic all-time cash printing opportunity for them. And I would look to get long some of those equities if that's the kind of thing that you do. So those are our 3 points. Coal selling for more than oil is unbelievable. Coking coal selling for a huge discount to thermal is unprecedented. And anybody who can buy cheap natural gas, make something real, and sell it on the global market is going to print cash in the next 3 to 6 months.
Hey, Doomberg, that's absolutely phenomenal. Really appreciate that. Quick question for you, though. Ed and Dr. Anas Al-Haji's in the room. Maybe he wants to jump up on here as well. The idea was, and Anas had made the point a few months ago when crude was up at 125, 130, that watch out, reasonable chance could 200,000 barrel change in demand one way or the other, prices could fall precipitously. And he was, how should we say, that observation was not widely received or applauded. He's proven to be totally right. I'm a big believer. I'm a conspiracy theorist. I believe you are as well. And someone earlier in this call mentioned it, that there may in fact be some behind the scenes machinations whereby the oil price is being depressed in the short run in advance of the U.S. elections. But again, I don't want this to make a political debate. I mean, this happens all the time. I'm just curious from where you sit, Doomberg, given that you're so involved in commodity markets and the extent to which the demand, the financial demand for oil has collapsed or is maybe being suppressed deliberately, juxtaposing that with what you perceive to be the changes in physical demand for oil. Do you think there's some credence to, and again, it requires speculation on your part, but that's
Sure.
what it's all about. do you think there's some not so hidden hand of government intervention going on here, handshake agreements between certain Mideast interests, perhaps, and the Biden administration, so on and so forth? And again, I don't want some political debate because
Sure.
both sides do it, but it is certainly surprising to some. Maybe you could just talk a little bit what you think is really going on in the oil market.
Well, I would say as an investor, if you're debating politics, that's negative alpha. If you're trying to understand politics, then you have the potential to create positive alpha. And so, in the context of trying to understand politics, I think you need to look no further than the desperate rate at which the Biden administration is emptying the strategic petroleum reserves ahead of the November midterm elections. 4-week rolling average of daily injections of crude into the market is something like 950,000 barrels a day. That's finding its way to domestic and importantly international refineries who have the excess capacity to produce finished products, which then get moved around the world and have dampened the price of gasoline in the U.S., which is Biden's number one focus and his obsession. So I would say that if you think there is no manipulation in the paper market for oil, you would be naive. But our point earlier on the first one between coal and oil is that the demand for coal is just off the charts. China, Germany, Europe. So regardless of whether the paper market for oil is being manipulated, the physical market for coal is just exploding. And despite oil being a provably superior fuel with infinitely more downstream use applications, the market is currently telling us they'd rather just have this black rock they can burn to produce electricity than this, a barrel full of potential value add. And there's something very meaningful. It could be that our interpretation of that chart, signaling towards sort of a stagflationary environment, is the incorrect one. But that we're running out of reasonable explanations for such a market anomaly. And look, as you know, you've been around forever. When you see something on your screen that is both unprecedented from history and also surprising you in a way that is very difficult to understand, you certainly can't quickly come to any definitive conclusions. You can only try your best to guess what's going on, and that's what we're trying to do with our Pro Tier webinar tomorrow.
Yeah. And last thing, Doomberg, before we go to Jeff Garbacz, because you watch Europe closer than anybody, the European energy situation, and kudos to you for calling this out well in advance of others. At the margin, is there anything noteworthy in the last couple of weeks from the political side, whether it's what's going on in the UK or elsewhere, which leads you to think that maybe we're past peak ESG?
I think that ESG is not going to go down without a violent fight, and so now I wouldn't say we're past peak ESG. On the plus side, things that maybe signal that I would say we're past peak stupidity would be Liz Truss's statement, all of the above strategy for supply. But there's a couple of wild cards on the downside. So the military situation, which we are the first to say we know nothing about and can't predict and have nothing to add, seems to be getting more confrontational and not less. If one is to believe the sort of algorithm curated feed that Twitter would like you to see. And so that's a wild card. And then the other thing that really strikes us is this sort of coordinated focus on, quote, storage levels in Europe, as if this matters, tells us that there's a propaganda campaign at work here to try to remove some of the panic that might be beginning to break out to the extent that it has in certain European countries. If you can only store 10 or 15% of your needs, then the percent that you have stored is stupidly irrelevant. And yet we see country after country and, Twitter bot after Twitter bot and various other sort of high profile accounts pointing to, quote, percent of our storage capacity being filled, even though percent of your capacity that you need, that you can store, is conveniently ignored. Whenever we see smart people pointing to irrelevant statistics, we find ourselves wondering whether there isn't a deeper sort of campaign underway. And so not clear yet. And by the way, let's just say it. I mean, German PPI printing at 46% is a catastrophe. It is a crisis. The crisis is here. The only question is what's next and how do we get out of it and how do you call the bottom and are you going to catch the knife and all the things that everybody in here has been talking about. But the German PPI at 46% is a catastrophe, especially where yields are trading today. And so the consequences of the bundling of the energy policy are here now. And then the last point I'll leave you with, and it's a point we'll be making strong tomorrow, is even when we get through this winter, we're going to be heading into spring with almost no gas and have to do it all over again. Like the forward curve for Dutch TTF natural gas is pricing $50 per million BTU into 2024. $50 per million BTU compares to $3 per million BTU in Canada because Justin Trudeau has decided there's no business case to capture that spread, and Canadian natural gas is trapped. We really are living in a world of political absurdity, and we'll have to just see how it plays out.
Doomberg, I love listening to you because, hey, you've got such wisdom. But this is when I listen to you speak sometimes, it almost sounds like I'm reading something from the Babylon Bee or the Onion. It's like you can't make this stuff up. I mean, when you talk, I mean, you need to work in that famous quote from Jean-Claude Juncker. When it becomes serious, you have to lie. I mean, you're talking about the smart people saying stupid things. This is just. It's like we're living in a parallel universe. I mean, I just pinch myself.
Well, let me give you some real numbers. So the United Kingdom, through its own stupidity, can store, wait for it, 1% of its annual natural gas, right? So the fact that the UK is currently sitting at 100% storage capacity is irrelevant. Now, Germany can store about 25%. So the fact that Germany is sitting at 90% storage capacity is a good thing. Doesn't mean they're going to get through the winter. Austria can store 80%, and they're sitting at 90% full. Austria is going to be just fine. Pick your favorite country. This is all knowable data. But when people are bragging about percent of our storage that is filled, there's a whole separate parameter that you need to look at, which is, okay, how much of your daily needs for natural gas can you pull out of that storage on any particular day, if and when you need it? And for much of Europe, they're woefully short. And we'll see. Putin is still putting gas through Ukraine into Europe. That could end any time. It's going to be an incredible winter. And look, we are hoping for a mild winter. We're hoping for peace. We hope that Western Europe doesn't have to go through what it's staring down the barrel of. If it's a deeply cold winter and hostilities continue to escalate, there's going to be a world of hurt. And when you have to ration, we didn't even get into it. The means by which you ration matter. Like how, if you don't have enough molecules for normal demand, the manner in which you allocate those molecules matters a lot and can either exacerbate or make the crisis a little better. And we'll take the under on the political leadership's capability in Europe to allocate those limited molecules.
All right. Thanks, Doomberg. It's great. Please stay there. I'm sure I have more questions. Let's get the batting order reset here. We've got Jeff Garbacz stepping up to the plate, and then KFAB, and then Amy, and then Michael Belkin. Hey, Jeff, what's up? Jeff?
Hey, how are you?
Good. What's up, man?
Good. So I thought I'd just throw some ideas out there of some things that are going on. So, George, remember the last time I talked to you was towards the end of July. It was the third week of July, and we were going through the fact that we're having this rally going on, and that when and if it came to the end, we're going to hit the negative seasonality period, and if we had too many type 4s in the work, then we could see some ugly tax selling, and that's where we are right now. Suddenly we got there. It was 2 weeks off. Like you said, the middle of August, you're getting your premium amount of crap from people. And I had a couple of people who were like, oh, you're off, you're wrong, blah, blah, blah. And, now it looks really bad. By the end of, here's an interesting stat. In the middle of August, we had gone from 20% of stocks higher for the year up to 28. And then we finished August at 19%. And dare I say, we're down around 14% right now. So looks like some tax selling is being done. Remember that call?
Right. So, Jeff, let's not you and I take victory laps. What's the way forward? No. But Jeff, in the interest of time, what's the way forward, please?
The way forward is to look at some classic type 4s right now, just to throw them out there so people are aware of what could be sold from a tax standpoint that would be vulnerable. So ASML, just going to do 5 or 6 really well-known names. NOW. Adobe is a classic now, given that they just bought the company in the meltdown. Home Depot, Sherwin-Williams tied to Home Depot, Union Pacific, and CRL and CAT would be a couple interesting names. What's happening right now? What's interesting is the Erlanger option rank. We look at all sectors and see whether put activity is extreme. And we only have 3 sectors right now. Typically, when we get to this point where we've been down now 4 or 5 weeks, looks like it's going to be 5 of 6. And by the way, what's interesting is if you listen to the media, no one's making it seem like it's been down 5 or 6 weeks. They're making it sound like it's been much shorter, even though it's been longer in duration. So we need to get to like 20 out of 24 sectors being extreme to have another low that could be marked. So I didn't have any confidence coming in today that was going to be the case. So it's really interesting that people aren't massively hedging, because I think everyone, from my conversations today, it was 90%, oh, the Fed's going to pivot today and life is going to be great and wonderful. And guess what? That's not the reality. What the market has decided after 4 o'clock today, between 3 and 4, it went the other way. Next point is, if anyone goes to my Twitter page, I put up 2 charts, which is Bullet 86. The first chart is from a speech I did last week at the Academy of Certified Portfolio Managers, and it's an awesome chart. It's from my buddy Greg Forsyth, who I work with, who I consider to be the quiet quant out there, the least known guy who's probably one of the best guys there is. And it's a chart of the top 500 stocks by market cap. And it looks at the number of up EPS revisions. And if you look at it, it peaked at like 430 at the end of 2021. And now we've dropped down to about 220. And if we looked at the pandemic low, we got down to about 60 stocks. And if we looked at the 2008 low, we got down to 50 stocks out of 500. So we're only like halfway there on the number of downward revisions that could occur. It's a hell of a chart, and it goes all the way back to 2021, and you can see where we were coming out of the bottom there as well. We got down a little below 100. So there's more downward revisions that are coming. The next chart that I put up is a Fed chart, and George, I don't know if you can get to it on Twitter and take a look at it, but it's a really interesting chart because it's the weekly economic index, the WEI, which you can plot on Bloomberg as well. It's produced by the Federal Reserve Bank of New York, and it's an index of 10 daily and weekly indicators of real economic activity. And it's got 3 plots on it: the weekly economic index, a 13-week moving average, and then the GDP number. And you can see how since mid-21, this thing has been slowly dropping kind of bit by bit. And what's amazing on it, there's a shaded area. I purposely left it off for the presentation I did last week, and I asked people what it is. I'll answer the question now. The shaded area was the last recession. Well, the last time I checked, we're in a recession now because we've had 2 quarters of negative growth. And it shows you where the Fed is at because they're not shading this particular area. They've left it out, the shading out. So I think that speaks world to where the Fed is at. And if we look at the Jackson Hole speech, Powell said the word inflation 52 times, and he said the word recession twice. So coming back to our work right now, things look ugly. I mean, there's only a couple sectors that look good in the work: energy, utilities, and pharma. If I look at the Dow stocks, only 2 stocks in the Dow from our volume swing have positive volume: J&J and MCD, McDonald's. And we're taking a long short approach with our weekly screens of kind of low beta, high market cap. That said, the weaker stuff has been really, it's outperforming this week. It outperformed last week in the struggle week. And if you look at the difference. The longs are down 196 through today. The shorts are down 317. I have a feeling like you're getting to a really great point on the short side, especially if we break 3,800. Like
Right.
it may become like a fest the next 2 weeks on the short side.
So Jeff, you're basically saying you think we could have a waterfall. We could have big downside rate. The market could break. The defense could just give way.
Oh yeah, because the weaker stuff is underperforming.
Yeah.
And look, if the weaker stuff was doing better, no way would I be in that category. But it's not, and it hasn't been. And
it's a great observation.
I mean, it's probably, if you're a short guy, it's got to be one of the most important things you pay attention to. And if you aren't doing it through our work, do it on your own.
Right.
Come up with your own process and figure out how to quantify strong stocks from weak stocks. But the weak stocks are really dropping. So I agree with two last points.
Yep.
Tom Thornton talking about FedEx. I put up a tweet earlier this week on Costco, and I talked about FedEx. So when you say I FedEx something, that means you send something overnight. But now you're able to apply it to the stock market and say, my stock just got FedExed. You know? In other words,
Jeff, quit while you're ahead. You can't. You're not gonna. No. Come on. No, seriously.
So I will stop with this. But the stock that I showed, which I'm really worried about, is Costco, because it's a straight drop from 500 to 400, revisiting the lows earlier this year. And I'm in the camp of, you don't want to buy any stock. I just had a conversation with a client about this. Forget about buying stocks that have a lot of air under them, because if they break, they're going to get FedExed. You know, that's all there is to it.
Jeff, you're hurting me. Stop. You got to stop.
I'm done. I'm done with that.
All right. Quit while you're ahead, dude. Just stay there. All right. Let's keep it moving here. We got a great room. This has been awesome. I want to keep the pace up. So let's see if I got it right. We got Amy, and then KFAB, and then Belkin. Amy, what's up?
Hi, I think KFAB was actually before me. You want to go, KFAB?
No, ladies first, please.
All right. Sorry about that, KFAB. KFAB, she's cuter than yours. Sorry about that. Go ahead, Amy. What's up?
Hi, how is everyone today? So I haven't heard anyone really talk about this, and it's really where my focus is on is that the Fed funds rate, the terminal rate. So going into this, I mean, the market was trying to price in 4.52, and it was pricing out, 4.552. And he came out with 4.4 by end of the year, which I think it was 4 to 4.25 by end of the year, and 4.6 by end of 23, leading into the reduction in 24 and 25. So I just would like to hear people's opinions on a terminal rate of 4.4 before the end of the year.
So with
I think that is drastic, and I don't hear very many people talking about it.
So, Amy, are you saying Tina is dead? Is that what you're saying, Amy?
She's in trouble.
She's in trouble.
She's a damsel in distress, that's for sure. But
well,
I'm just curious what the panel's thought is on that, because I haven't.
All right, so I think I don't know what KFAB was going to talk about, but
that actually segues right into what I was going to say.
Yeah, exactly. So KFAB, it's T-ball time. I was going to give it to you, and then Michael Belkin's also good on fixed income. So KFAB, take it away.
Well, as you know, George, in last maybe 3 or 4 months, I've been trying to compete with Michael Belkin on the most deliriously bearish person on your spaces. And I think that, to Amy's question, if we go back to August and Lakshman Achuthan's space with you at ECRI, looking at leading indicators, they were basically talking about, and they're still talking about, the first synchronized global recession in 40 years across 22 economies that they gauge. And that was before Jackson Hole, and that was before today, and before the CPI print. And I think what the last 3 weeks have done, at least for me, is it's really opened up the left tail, relative to what's going to happen in the next 12 to 18 months. And it's almost like Brainerd and Powell or Thelma and Louise, like holding hands, looking to drive off the cliff, with really looking to tighten into the teeth of that forecast that's already kind of baked in the cake. And that's before there's any kind of major credit accident, which with what they're doing is almost inevitable, even independent of what's going on in China, what's going on in Japan, what's going on in Europe. So it may not even be a credit event in the United States that triggers all of this, but some kind of major credit event is almost predestined at this point, with Thelma and Louise driving off the cliff. And that opens up that left tail. And what does that mean? Well, again, people are so far in la la land. I mean, if you just to use earnings as an example, if the S&P revenue grows 15% this year and 5% next year, and you just slap an 8% operating margin on that, that's 150 in earnings, right? And where are consensus earnings at? Nowhere even near that. And that's a reasonably sanguine scenario. That's not the left tail. That's not, anything major happening relative to a credit event. The last thing I'll throw in there is Joseph Wong, who's another one of your recent guests, the Fed guy who used to work at the Fed. I caught him on an earlier space today, and he mentioned the idea that the Fed would revert back to some of the 2020 instruments and policies that they deployed relative to this idea, because Powell today saying it has to be compelling, the drop in inflation. Well, we know just based off of the mechanics and the stickiness of some of this stuff, that's almost an impossibility in the next 6 months. So if we start to see stuff break overseas, and even in the United States, some credit events, they may go back to things like direct commercial lending, even though that's technically in violation of the Federal Reserve Act. That they have these other levers that they can pull that are not going to be cutting rates and going back to QE. So I think people need to completely reorient what their cycle risk parameters are, and that this myopic expectation that we're going back to Fed QE because something breaks, I think that is just so completely wrong.
Absolutely. That's sort of where I was leading with my question, was like when Jeff was talking about getting FedEx. I think if they move that fast for a 4.4 by end of year, we're going to see a hell of a lot more FedEx moments in the market, because just the rush of these companies, I don't know. I think it's not good. Like when they to refinance, to sell off debt, whatever it is, it's 4.4 was that was the most surprising thing for me today.
So
I expected 4 to 4.25. I did not expect. I expected 4.5. I was looking at March 2023, and he's talking about 4.4 by end of the year. So I think we're going to see a lot more FedEx moments.
Yeah, and that's in the last 3 weeks, Amy. That's what we've seen, is that the forward curve has started to reprice, whereas they had been pricing in cutting next year. The quote unquote pivot based off of this global backdrop that I'm talking about. Mm-hmm. Markets have repriced for Thelma and Louise. That's what they're pricing in now. Yeah. That's why you saw the 30-year rally today in price, and that's why you saw gold reverse and now starting to, maybe putting in a bottom. Those have been the two missing links to Michael Guyed's, what he was saying earlier as far as risk off. They're starting to see that kind of flicker in the last couple of weeks, and today was just cementing. I mean, he's screaming this now. The Fed is screaming that this is what they're going to do.
But the bond market is screaming danger, Will Robinson. I mean, the 2-year. I watched the 2-year close as sort of the closest indicator to Fed funds, and it's at 4.05 right now, and that it hasn't been over 4 since 2007. So, it's just, I don't know how you wriggle out of this. I don't know. I guess I haven't really processed it all yet, but yeah, it's messy.
Well,
No
I think,
messes.
yeah, I think Amy, the last thing you said, it's messy. It ain't good. That's for sure. I mean, you were talking before about how, Tina's in distress. I mean, Goldilocks was proclaimed dead, months ago. All right. So she's gone. All right. Tina, I think, is already dead. No one's seen Tina. All right. So, I mean, this is not, I mean, my take on all this, like what happens to fixed income eventually, I don't really know unless people say, well, George, how can rates keep going up? We'll have a recession. Like, okay, fine. Bring the recession on, baby. Bring it. I mean, either way, it's horrible for risk assets. All right. And, pick your poison. We had the great moderation with, crazy excess stimulus in the form of both monetary and fiscal. And I don't want to steal his thunder. He's been in here before and he's been so right. And I'm glad he's here and he's now next up. And so, Michael Belkin, this may be a good place for you to step in and, talking about risk assets, fixed income, et cetera. Michael, are you there? Floor is yours, Michael.
Maybe touch on I don't know if you're fixed the fact that credit usage is the highest that it's been in 40 years, and now interest rates on credit cards are at all-time highs.
Yep.
So
That's great. What does that mean? Michael Belkin. Hi, Michael. How are you, my friend?
Good. Can you hear me?
Yeah, we're good. Go ahead, Michael.
Okay. Hey, thanks. Hey, this is great, George. Hey, by the way, I'm with you on biking, and I'm headed up to Whistler here for downhill biking at Whistler Bike Park. It's probably a little more exciting than road riding, but it's the right time of year. Get it in before winter. So today was I think this was a big day in the market, right? They tried to ramp it up on Powell's press conference. The S&P was up on 1.5%, almost 2%, closed down almost 2%. So that was I think that was a major reversal. I'm going to present a couple of things, some tactical trades I think are setting up, and then some longer term trades. So give you some trading ideas here. First of all, earnings. Okay, Q2 S&P 500 earnings, according to Standard & Poor's, 46.87. That's so far below what FactSet is saying. I don't know where FactSet gets their number, but those are operating earnings from the index provider. Okay, that's the consensus earning target S&P for next year is $243, which is like what, 60. They're expecting $60 a quarter. It's already 46.87, which is annualizing at 188. So it's 23% below next year target already if you annualize Q2. So what I do is forecasting using a proprietary model. It's a little bit like Fourier analysis, comes out of my studies. Different approach than most people use probably. Anyways, my target for S&P earnings 12-18 months is below $28. That's quarterly, which annualizes at 111. So even the most bearish person, Michael Wilson, who I like a lot and respect, right? He's still like in the 200s, like for next year. He's saying it's going to be 220 or something. I just think that's like double what it's going to end up being. So my earnings target is down 54% below what everybody's expecting. So if you plug that into your forward earnings estimate for the market's just like insanely overvalued. We're headed into earnings season. FedEx was probably the first, and of course, there's some great comments here. I really enjoy being in the company of everybody that's on here. I heard some great ideas here. FedEx, obviously, it's at the center of the global commerce system, and so I think that it's very bad foreboding about what the pre-announcements that we're going to hear right away. I mean, starting now, this is pre-announcement seasons. So earnings are going down big time. Market's overvalued. What do you do? Here's what's setting up. Right now, I have the daily, weekly, and monthly turning down for the S&P 500 and the NASDAQ. So daily, I have a 12-period forward forecast. So next 2 weeks down, that's 12 days, 2 weeks, ballpark. Weekly, 12 weeks, 3 months down. Monthly has been down for a while. It never wavered. So my monthlies turned negative at the beginning of the year, late last year. So they're all kind of kicking into the downside. And I heard those comments about the DeMark indicator. We've been down a lot of days in a row. Maybe it'll happen fast. It could happen very quickly at this point. But anyways, the VIX So the market's headed down, in my view. I think you should be short, period. Like, I think it's a great time to buy put options. Here's why. VIX, 28 today. Strong upward model forecast. Okay, so the VIX is probably going to explode. It's just really, it's depressed by for whatever reason, I don't know. People like to sell volatility. I think there's going to be a volatility squeeze. So that means the point is options are still relatively affordable. And they're not cheap, but they're going to get a lot more expensive. So you could get in puts, I think you could get a volatility expansion as well as a big payoff directionally. So I like shorting the NASDAQ, QQQs, deep liquid. 270 is a good place to start. 270 December puts. None of this short-term stuff, man. Those just too crazy and too volatile. But out 3 months or something. So QQQs December 270 puts for a trade. Remember, options go to zero. The time decay just keeps going down. So you don't want to be long these. Put them on and forget about them. For a trade, 1 month, 2 month view, puts. What else? Bonds, TLT. Interesting day today. Up 1%. The NASDAQ, with the S&P down 1.5%. So that's something I've been looking for. It's been painful. It hasn't worked. So TLT is at 108. 200-week average is 138. That's up 8%. Nothing nothing huge. It's actually more than that, like 20 something. It's more points than that. But anyways, why would bonds rally when the Fed's raising interest rates? We've had some great comments already about that. I think macro traders, hedge funds, et cetera, have had a great year. They're short bonds. There's a huge, ginormous short position, 1.4 million contracts, which is insane across 30, 10, and 5, last time I looked. So there could be a gigantic short squeeze in long bonds. And we had some comments before about why would bonds rally, risk off. Simple as that. Out of stocks, into bonds. And I witnessed that. I've said that before on here. When I was at Salomon Brothers, we saw a gigantic pension fund asset allocation in the 87 crash do that precise trade. They sold all their stocks, paralyzed our trading floor, bought and shifted into bonds. And that's when Tudor Jones made his name, by the way, by buying bonds. He made more money being long bonds, he said, according to him, than being short stocks because bonds are so liquid. So I like bonds. It's been very painful. It's not like I want to go out and mortgage the house and buy bonds. But if you're going to looking for some contrarian trade, long Treasury bonds, not the short end. I do not like the short end. Fed's still raising, so the yield curve could just invert, go into crazy more inversion. Okay, dollar. Now, I'm looking for the top in the dollar. Sure didn't happen today, but it's another one of those overowned positions. And why would the dollar go down? Because the U.S. economy is headed down. Okay, so my forecast, we've had a lot of comments on that about that already on here. My forecast for all these economic indicators, as another commentator pointed out, we have 2 quarters down in GDP, and this one's looking flat at the latest from Atlanta GDP now. It'll probably end up being negative. So economy down, earnings down. That's why bonds would rally. And the psychology of the market, let's talk about psychology for a second. I think it's really, really messed up. I've been getting a lot of pushback. Actually, I have one big hedge fund client. All they want to hear from me is when I get pushback, because they think contrarian sentiment, like when people are too on one side of the trade, they're going to get squeezed. I've been getting a lot of pushback on the bond, long bond idea. So that's something for you to consider. People they don't see a reason for bonds to go up, and there's a massive short position.
Mike, real quick on that point, I'm glad you mentioned the Treasury part is important for people to realize that it's not just in absolute terms, but also relative, right? So in classic risk-off periods where you have high volatility in equities, stocks go down, Treasury yields on the long end drop, you can, on a relative basis, get 2,000, 3,000, 4,000 basis points within weeks in terms of the spread against equities. Yeah. I'm not saying that haphazardly. Right? If you look at the data in terms of historical corrections, when Treasuries move on a relative basis, it's like convex tail type investing on a relative basis, right? So that 8% may not sound like a huge number, but that could happen as the S&P is down 20% as it's going up 8%.
Exactly. So that you're talking about the ratio, TLT, correct. S&P exactly. 500 ratio. That's what I look at. Huge buy signal on that. So that's for institutions. Big asset allocators, they can only do like three things, bonds, stocks, or cash, or maybe a little gold. But a lot of them, they're constrained. So that single, binomial, whatever decision out of stocks into bonds, I think it's setting up big time for that's for big institutions. That's not for little traders, So different audience for that trade. Let me run down the list real quick. I don't want to take all day on this. Tech relative to the S&P turning down big time. So XLK divided by SPY down. So there's been a lot of comments on that about FANG, overowned, Apple, all that, blah, blah, blah. Total agreement. Tech is, and of course, there's a Bloomberg story, or was it Reuters? Hedge funds loaded up in August on tech. So they're on the wrong side of this. I think they'll be puking tech along with everybody else. But getting back to the psychology, so I've been getting a lot of my clients have been saying, why isn't the market going down? Why is it going? Everything is obvious. You read the headlines, what's going on. You get FedEx. Why isn't it down more? Retail is buying. If you look at the flows, it's been all institutions selling for like months, for 6 weeks or 8 weeks or something. Retail is still buying. So retail, these poor people, God bless them, they've been programmed by 13, 14 years of QE that the Fed's going to bail them out every time the market goes down. So if you look at the market every day at the open, TRIN, it shows there's like huge buying. These guys are like kamikaze buyers into the open every day. I don't know where it's coming from, but there's a huge number of buy orders. So the market opens down. The game is always to bring it back to unchanged. The Q's open down 1-2%. Buy the dip, buy the open. So that psychology has got to get crushed. For the market to go down, retail has to get taken out. So I think they're on the wrong side of things. It's been working for them for short-term trading, but come on, we're down. The market peaked August 15th. We're down, big time from there. We're almost back to the lows of, we're 4% from the lows back where we were in July. So anyways, end of June, July, I think we're headed a lot lower. I think retail is going to get taken out. Then who is the buyer? There's just like no buyers. A couple other, oil, we talked about oil. My long-term forecast for physical oil points straight down. And in 2008, it went up big, peaked in the middle of the year, and then went down 50%. I'm still short crude oil, all these things. It sounds crazy if you read the headlines because of shortage in Europe, et cetera. What happened with energy stocks, of which I've been wrong on, is the XLE USO ratio. In other words, energy stocks relative to crude oil went up big time. So I think there was a kind of there's been a buy into something after the peak in energy prices. People decided now's the time to load up on energy stocks. I'm not a perma bear on oil and energy stocks. 18 months ago, these things were screaming by. Nobody wanted to touch them with a 10-foot pole. Now, big institutions, the latest B of A survey, second largest overweight position. So dangerous, tech is dangerous. I think short tech, that fits in with the short QQQs. Now, something else that's setting up. Oh, by the way, let's talk about one other technical thing on the market. Advanced decline stuff looks terrible. Today, the McClellan Summation Index, I don't know if you guys follow that, it crossed zero on the NYSE. They're both negative, NASDAQ and NYSE. And that's what happened right before the 87 crash. So it's just something else to keep an eye on. In other words, more stocks are declining and it's accelerating to the downside. We're day 3 negative for the McClellan Summation Index today, minus 542. Very negative signal on the market. Now, some other things that are setting up. Silver was up 7% last week. I do a gold stock report as well as a Belkin report. I publish 2 things, Belkin report and Belkin gold stock forecast. Anyways, the gold stocks are looking really interesting. They're bottoming. They've had the stuffing knocked out of them. And while the market was going up, they were going down. Peaked in April, I believe, GDX, down huge. They look really bottoming to me. It's going to be hard for them to rally much, if the market crashes, but I would keep an eye on the GDX and stocks. Here's some of the stocks that look like they're really bottoming to me. Symbols, AG, that's First Majestic, Coor, CDE, Hecla, HL, MUX, BVN, KGC, Kinross, Eldorado, EGO, even Barrick and Newmont. They're both kind of crushed. So if you're looking for a tactical trade when the dust settles here, again, it might be hard for them to rally much if the market's severely weakening. But gold was up today, GDX was up today in a down market. Interesting position. And the silver gold ratio has a huge buy signal. So like I said, silver was up 7% last week. Gold wasn't, was up hardly at all. So silver outperforming gold, new signal, strong upward forecast. That's a bull signal for precious metals. So when silver outperforms, there's usually precious metals go up. It's not a bear signal for the market. So you should be asking yourself, what would make precious metals rally? Even when the dollar, dollar's up like 1% or something today, gold stocks, and gold and silver up. So could be, geopolitical, Russia, Ukraine, something, who knows? China, Taiwan, I don't know, setting up for something. All I can say is gold and gold stocks looking for an excuse to rally. I don't know what the excuse is at this point. And finally, last but not least, the only two sectors, these are for big institutions, utilities and staples. Those are the utilities have been a huge outperformer, like outperforming the market by 20% or something so far this year. That's XLU. And staples, XLP. Now, these are not, I'm not saying go out and buy these absolute terms, but for institutions who are stuck being long, you have to have a long equity exposure. A lot of people are in that position, big money managers. They can't just go 100% to cash. The only major sectors that look like they want to keep outperforming are utilities and staples. And those are just total chicken longs, right? Higher yielding, stocks that nobody wants to own, really. Like you're going to buy PEG. I mean, it's not sexy, right? It's not exciting. Same thing, General Mills, things like that. They came out. But so those are the only, if you're a big portfolio manager, overweight utilities and staples, underweight tech. And so there's a couple pair trades setting up there. So long XLU, short XLK. That's a huge alpha potential there. Same thing, XLP, XLK, even long GDX, short XLK. So a lot of pair trades, tactical things for fixed income managers. I'm sorry, for big portfolio managers. And just to get back to the idea, I'll stop right here. Shorting the market, I think we're in breakdown territory. I think it goes down big. I think retail is going to get taken out. And after that, there's like nobody there. And there may be some people are bearish. Yeah, sentiment is bearish, but have they completely? Do I see signs of capitulation out there? No, not at all. It's going to look at the bottom. Retail won't want it. They'll be getting margin calls. They won't want to touch it with a 10-foot pole. So I think,
Michael, I think the last point you made is really important. People have forgotten about it. That is, you had that over $1 trillion of retail buying last year. And there's been hardly any selling. I can't remember the last numbers, 40 billion, 50 billion, whatever. And people have taken that as a given and they've forgotten about it. But they haven't even thought about puking yet. All right. But that's still in front of us. Not to mention, I think you're going to have massive hedge fund redemptions as we go into the fourth quarter here. And so, it's just, Mike, let me ask you this. You and I have known each other for so long. I asked you this question last time, but for those that don't follow you, don't know your work as well. I'm always impressed not just to hear what your signal says, whether you're bullish or bearish on the market or a particular asset, but also the intensity of the signal and where we are in the continuum. It's early, it's middle, it's late. So what's changed in the margin for your negative views on the market is this. The signal's not brand new, but I gather the intensity is still very strong on these signals. Is that correct?
Yeah, long-term monthly signal. So monthly, 12-period forward forecast, monthly data, 12 months, 1 year. That started at the beginning of the year, right? So we're about maybe 60% through time-wise through this move down with no end in sight. That can extend, right? So it's as strong as ever, super strong. That's monthly. Weekly is just beginning to kick into the downside again. So, and that's a strong, fresh signal. So 3-month view down, 12-month view down about halfway through, and the daily turning down too. So I don't know what's going to keep this thing up. Other than it just doesn't. My confidence level is pretty high. All the cycles seem to be coming together to the downside now.
Can I just add 2 quick comments on that? So at this point about utilities and treasuries. I recall
Michael, I'm sorry. We've got a pretty full stage, and I think we've spoken enough about utilities and
well, no, I was
rates.
just going to make a quick mention about the 87 crash, because I'm pretty sure, Mike, that 10-year yields were spiking before that, and utilities were strong in advance of the 87 crash.
Yeah. Also, one interesting group then, insurance was the best performing group the week of the 87 crash. And I've actually, insurance is like a low beta defensive financial group. I'm not bullish on financials overall, but all of a sudden I'm getting outperform signal on insurance stocks in Europe. We haven't even talked about Europe. There's no time for that. But Europe, I can't believe the cyclicals haven't crashed there yet. They're going to be turning off the power. Good grief. They're still buying auto stocks and industrials. I don't know what's going on. Whoever's buying Europe, good luck. But yeah, so the low beta utilities, things like that, huge outperformance potential in a crash.
Awesome. Michael's always great to hear from you. Please stay on stage. I'm sure there'll be some follow-up questions. Going to go a little bit out of order here because we had some technical difficulties. We're going to do Schmuckatelli and the guy with the best Twitter handle on Twitter, period. Joe, always good to hear from you. Particularly curious your insights, in particular on the military situation, what's going on in Ukraine. You and L'Enfant, I don't know where he is. I haven't seen him for a while. We're very prescient and correct, going way back to February, before the first troop moved. You were warning everyone that no, this is real. He's going to invade, and all the talking heads on CNBC and the rest were completely wrong, and you were completely right. So I'm just kind of curious, Joe, where you sit right now. I know you don't have any inside information or anything, but just using your good old common sense. What's your take on what's going on in Ukraine right now? Putin making noises about mobilizing. I've been reading stories as well that people are concerned that he hasn't been given really an easy off ramp, and so this is things kind of heading to boiling to a head. So any wisdom you could impart on us vis-a-vis what's going on in the Ukraine, plus anything else you want to talk about, I'd be very grateful. Good to see you, Joe. The floor is yours.
Thank you, George. Thanks for having me up. Actually, Matt Warder had a space last night. We're all anticipating Putin's speech, and he was giving the speech as we were on there, and so there was a lot of good discussion there. Matt Warder, great follow for any of you guys that are interested in coal and just life in general. Matt's a wonderful human being and a coal expert, probably the most brilliant coal guy out there. So, look, in short, I'll keep this very brief. Putin is weak, okay, and he wouldn't have done this. This is a sign of weakness. Also, observe Azerbaijan, Armenia, observe Tajikistan, Kyrgyzstan. All around what he wanted to be a greater Russia, things are falling apart at the seams. He's losing his perceived and real authority in the various outreaches of the old Russian Empire. And I think that we're seeing more and more symptoms of this. Who in February believed that there would be you call it what you want, either a general mobilization or a limited mobilization of additional troops in Russia in late September? So this is a sign of weakness, okay? Now, I read carefully the text of the speech. Anybody who's a veteran with military experience or with skills that the military could use. So that's a pretty gaping, that's a wide loophole there, can be drafted into the military, can be drafted into the army. There's also been reports of busloads of prisoners. Basically, they've been given offers. If you serve on the front for 6 months and you serve honorably, and you make it through alive, your sentence will be vacated. If you die, you have a choice. You can either die here or you can die there a war hero. And they're shipping prisoners to the front via prison buses to, either for cannon fodder or to back up the troops that are there. These are signs of weakness, okay? Well, you might say, oh, well, Putin's weak. Well, you know what? There's nothing more dangerous in nature than a wounded animal that's been cornered. And this is what scares me. So, yeah, the Ukrainians have made tremendous steps forward over the last few weeks, taking back significant territory in the Donbass and in Izium. By the way, they found another mass grave in Izium. The human atrocities continue at unbelievable levels. I mean, mass graves, and it's become so normalized. But please, take a moment to think about the atrocities that Putin is committing. He is not bounded by any kind of standards of behavior that we have in the West. And so we shouldn't therefore mirror image upon him our morals, because he doesn't really seem to have any. But back to the point, I think it'll be harder for longer. So this thing is going to continue. Ukraine has indicated they won't be happy until every Russian soldier is out of Ukraine. And Putin is showing, especially with this limited mobilization, that he's not backing down one bit. This is an existential issue for him. He realizes that if he leaves with anything short of victory, not only would it mean a loss of power, but it could actually mean the loss of his life. So what I'm worried about is how desperate will he get, and how much more ruthless will he become. He's already been attacking power stations. I haven't ruled out that he might consider the use of WMD, and I'm talking mainly bio or chemical in that regard. And if that happens, this whole thing goes into a whole different order. And so that's kind of my general look right now. In short, for the people in this room that are worried about, thinking about their investments, I think this goes on for the foreseeable future. Neither side has shown that they're going to back down. Both sides have shown that they're going to continue. And also, I don't believe Ukraine right now has the wherewithal to completely and totally remove Russia from every inch of their soil. And until that happens, we have a stalemate or a continuing battle. So that's what I see right now, George.
So, so this is going to, your take on the over under, longer or shorter. You're taking the over, just so we're clear on that. Is that right?
I'm taking the over, and then if there's a discrete moment, a quantum moment of WMD use, or just something appalling to the world, that could change. That could change the dynamic here. But if it keeps going as it is, this thing could go through winter.
Wow. It's wow. And Joe, I mean, it's so hard to know, but do you have any further insights vis-a-vis what's going on behind the scenes? Any back channel maybe just guesses, but are there back channel communications going on between the U.S. and Russia, and or is it just there? Or as you said, each side's just getting backed into a corner. So they're becoming more and more distant. It's becoming more destructive as opposed to constructive.
George, I would say I believe there must be, okay, in diplomacy, you have to have a means of communication with the other side, even if you keep that, kind of low key, and you don't advertise it, and you keep it secret. There's got to be lines of communication. So you can bet that there's third party intermediaries. It could be the Indians, it could be some other third party country that might be acting as a conduit, but I have no information on that, and I don't want to purport to have that kind of information. I would say this: there's a popular line of reasoning out there that at a certain point, someone is going to basically take out Putin. And I strongly disagree with that. Just yesterday, another oligarch fell out a window. It seems like anybody who shows any sign of dissent whatsoever is being dispatched with very quickly. Either at the very least, they're out of their job if they're in government, or they're out of the public eye, or worse, they're just killed. Usually it's the latter. So he's systematically eliminated anybody that showed signs of any kind of resistance whatsoever. So I really don't believe that anybody close to his inner circle right now has the psychological leanings or with the wherewithal to do anything that would take out Putin. So I think if anything, he's stronger within his inner circle now than he's ever been, because he's on guard and he's taken out any perceived opposition.
Wow.
And the Russian people have been trained quite well. He's brutally suppressed any type of protests. So people should not expect any kind of democratic protest to break out either. So what we have here is a dictator who is carrying forward with his will. And, how it will end, it's going to end very badly for one side or the other, because both are entrenched and both are dedicated. On balance, The Ukrainians their morale is extremely high. They have some of the best weapons the West has to offer. These HIMARS can hit targets from 10 and 15 kilometers within a 50-foot radius. These are extremely capable weapons, and they've done a lot of good things with them. In fact, I believe the HIMARS have helped them to take good portions of the Donbass. So the Ukrainians show no sign of letting up. What I am worried about is escalation on the Russian side, and if he uses asymmetric warfare by taking out power stations, continuing to go after civilian population centers with cruise missiles, or something much worse than that, which I alluded to earlier, WMD, or attacking nuclear power stations, things of that sort.
Hey, Joe, just one thing. And Doomberg's still up here, so you may be interested in it. Well, whatever. When you talk about he's not held to standards of behavior that most people would be, he lacks a moral compass. When you start thinking about, just turning the lights out or turning the heat off on Europe, Western Europe, this winter, I mean, he literally has them by the balls. And given the way he thinks, the way he behaves, his worldview, again, I'm not suggesting you have any particular insight on this, Joe, but it certainly wouldn't be much of an ask really for him, given the way you describe him, to imagine him just turning the lights out or turning the heat off on Western Europe this winter, would it?
Oh, I totally agree with that. The only countervailing debate argument to that would be he actually does benefit from the currency he's receiving from selling his gas, oil, and coal to the world. And make no mistake, it's getting to market. It's getting to market. Is it declining? Yes, it's declining a little bit. Not as much as people originally had hoped for back in February and March, but there's a natural decline going on because of a brain drain and lack of technology. But they're patching it together and they're making it work. But the short answer to your question is yes. I would not put that past him. And I think the only thing that keeps him in the game is the currency that he does get at these exorbitantly high gas prices.
Right. Wow.
Hey, Schmuck, you did see that Zelensky came out with 5 non-negotiable conditions to, I guess, a resolution with Russia, right? Did you see that he spoke at the UN, a pre-recorded announcement?
So, Amy, what was this again?
Amy.
No, Amy. This is Pelosi?
No, Zelensky.
Oh, Zelensky. Sorry.
Yeah.
Sorry.
So Zelensky, he had a pre-taped, I guess, speech, we'll call it, for the UN. And he listed 5 non-negotiable requirements for peace with Russia. And he said, punishment for Russian aggression, restoration of Ukraine's security, Ukraine's territorial integrity, security guarantees for Ukraine, and punishment for war crimes. He specifically said castration. But those are his 5 conditions that he listed out.
Wow. Right. So that lets you know the general frame of mind. Like that's a bold stance. That's not somebody who looks like he has any quit in him at all. So you know where the Ukrainians stand.
Yeah. And he also said that the world, not just Ukraine, the world can't give in to him saying they're going to go nuclear, because the next, tomorrow he could say, well, we're going to invade Poland. But if you don't give us what we want, we're going to go nuclear. So he's basically saying nobody buy into that shit is what he's.
Amy, you're a barrel of laughs today, my dear. Unreal. All right, Joe, stay up there. I'm sure you'll get some more questions here. Let's keep this moving. It's been an incredible room. We've been going for a little over 2 hours. I think we're going to stop this at 6:30. So I'm serving the 21-minute warning. So in order, I think it's Wall Street Silver, and then Gnostic. Wall Street Silver, good to see you. What's up?
Wow, you're making me follow Belkin and Joe after that. I mean, I got nothing, man. I got nothing for you. But Belkin, I'm blown away by what Belkin was saying. So hats off to you, sir. I was very impressed, and I'm going to be following you going forward. But I have more of a question than any broad statement going. I think back to 2008 and the great financial crisis, and what sort of, we all know it, Lehman Brothers is what tipped it off, because Lehman got so far on the wrong side of so many of these highly leveraged plays they were doing in the bond market. And does anyone have any insight? I mean, I got to think what's really going to trigger the Fed into changing direction going forward is going to be something systemic, something that's not just the market going down or, price movements one way or the other. It's some systemically important entity, some huge hedge fund that's failing. Someone's on the wrong side of a lot of these huge moves that we're seeing, and not everything can be hedged. And does anyone have any real insight as to who's feeling the pain out there right now? Are any of the banks just really getting crushed in their derivative positions right now? Or
So
you know what I'm that's what I think is going to be the trigger here, if anything, is someone key to market operations just being really in trouble at some point. And I got to think that that's coming soon.
I have a suggestion, something to keep an eye on. It's the counterparties to the European power producers who are facing massive margin calls because of their hedges, as we saw the blow off top in electricity prices over the past 2 weeks. But of course, central bankers have gotten much better at dealing with such crises, and we've become dulled to the headlines. But $1 trillion here worth of margin calls. There's counterparties on the other side of those margin calls, and I think they're the European banks.
Yeah, I'm gonna Wall Street Silver. I'm gonna make a shooting from the hip. The real debt accumulation this cycle. At least let's just look at through the various economic actors out there. The U.S. private sector. I mean, you look at debt. I mean, I don't want to refer to debt service ratios people commonly refer to because interest rates are so low. So of course those ratios look all right. But even if you look at total debt levels, the real problems at the sovereign level, not so much the private level, and even more than the U.S. It's these foreign countries. So whether it's an EM blowing up, or we haven't really talked much about China here. And so if you said to me, look, we'll never know a priori who it is, what it is. You never can know. No one, all right. But if I had to guess, I think it's going to be a government somewhere. Whether it's maybe some country, maybe an EM problem somewhere, rather than a U.S. bank. I mean, ultimately, when it all goes to shit, of course the banks get nailed. But the thing is, they were one of the many things they did out of the GFC and everything. The change in the capital requirements, all the rest of it. They made them less vulnerable to getting into trouble. It doesn't mean they won't get in trouble, but they're not the weakest link in the chain this time. So, they always say history doesn't repeat itself, but it rhymes. I actually think it's going to be a government that gets into trouble. I mean, who knows? Maybe going back to the European debt, the European energy situation, maybe people start looking at, we're getting all this extra spending by European governments to offset the higher energy costs, and people start looking at the UK budget deficit or whatever. I actually think it's going to be a sovereign that gets in trouble this time. That's just my guess. I don't know if anybody else in the panel wants to hazard a guess. Anyone? All right, not hearing that. Let's move on. So I think we've got Chad, and then we've got Gnostic and then Chad. Gnostic, my friend, what's up?
Oh, everybody keeps taking my questions and what I was going to say. I was going to say it's going to be a sovereign or a semi-sovereign, demi-sovereign problem. Long-term capital resulting from Russia decline in its currency, or somebody reflecting off a sovereign debt of some sort just suddenly turns around and explodes. And there we've got the leading one. But Doomberg, your comment on coal. We're in a coal shipping deal out of BC, and we're getting the operator is reestablishing a mothballed coal mine to ship coal to a previous customer in Japan. And now there's bids coming in from other Japanese customers sitting down wanting it, and even coal at its current price. The phones are going off with people looking for supplies of coal in places that I never thought they'd be doing. But the follow-up question to you on that is, Westphalia is full of coal. What would it take for Germany to actually bring its coal-fired generators back online?
Well, they're doing a lot of that, perversely, we would say. But yeah, I mean, your anecdote is totally consistent with what we're hearing from the market. The part that I can't figure out is this coking coal, and I'd shoot it back to you and say, you got a plausible explanation for me for why a sort of higher BTU, lower sulfur quality coal is not being bought up at a $150 discount? I mean, I'm just totally confused by it.
Yeah. I mean, there's a simple answer to that. Thermal coal and generating coal, they just need more and more of it, and they're stockpiling just in case. So the quantity shipments and quantity orders of thermal coal has gone through the roof, just because everybody wants exactly what you were talking about. I can store it, I can stick it someplace. I've got backup. I've got it's emergency supplies in case it's needed in places where it's not there. And thermal coal has a pretty standard delivery and pretty standard demand curve, whereas metallurgical coal has a pretty standard demand curve, whereas thermal coal has gone down its demand curve so far. Suddenly it's spiking, and that's creating a demand for it that's exorbitant relative to its shipping. I also sent you an email that says some of the other stuff. So there's coal export ports that are now under strike notice. That if they go on strike, now there's a shipping problem added to the coal delivery problem, and coal delivery demand increases. So there's multiple things that are impacting it. So inflation is reflecting on the salary demands for coal shipping terminals. So you can store it in the shipping terminal, but you can't get it out. You can't load it on the ships. And now you've got an increased one. So that strike notice that's gone out has basically caused the buyers to go in and say, hey, get it here fast, because if there's a strike in delivery stuff, we're really stuck. So they're just going after it like crazy right now.
So we have an answer, the best answer. It's coming as to what the sovereign. Newman, it's yours.
Hey there.
Market.
Yeah. So, I mean, look, Michael Belkin and George Noble, two people who maybe called close to the top in 1989 in a little country known as Japan. That was where the original QE experiment continued to this day. And I think that if we're looking for a sovereign to point the finger at as to where this house of cards comes down, my vote would be Japan.
Not a bad guess.
That's all. Thank you.
Yeah, that was cool.
Doomberg, you may have called it.
Yeah, it's I mean, if you look at the weakness of Japanese yen, and then this orgy of buying in primary energy sources, it tells you the sort of real truth here as to what's going on. And I think we had a good discussion earlier about the violence of the move of the Japanese yen is really historic. And when we look back at this era from in 5 to 10 years from now, when you're in the middle of a crisis, it's sort of hard to to measure it, but it's pretty historic stuff that's going on with Japan. So that's actually a very good guess and a great insight.
Yeah. No, Doomberg. Newman, hold on.
I would also just say, keep an eye on that CPI, because it was 2.6 last month, and that's nothing. But if it goes up,
Newman, hold on.
Okay.
Michael Belkin, are you there? Michael Belkin. Hello.
Yeah. Hey,
Michael. Did you just hear?
Yeah.
We're talking about possibly Japan being the source of the big instability, and given that I think you and I are the senior ranking elder statesman on things Japanese. Just curious, what is the potential? When you look at the charts on the JGBs and on the yen, I mean, the idea that maybe Japan is going to be is the originator of QE. It could be the epicenter for the blow up, because we're trying to speculate where the big problem could emanate from. When you just looking at the charts, what do the yen and even more interesting, what does the JGB look like to you?
It's not on my radar screen, the scenario that was just presented, and that doesn't mean it won't happen. But I'm friendly to Treasury bonds, government bonds, 10 years everywhere, including JGBs. So I don't think JGBs crash. The yen is out of control, but the weird thing if you look at the Nikkei, right, it hasn't gone down like other world markets because the BOJ is in there buying it. They own like, I forget how much. They're like huge buyers of equity ETFs.
I think it's nearly 80%, Michael. Almost.
Yeah.
And the bonds are 50%, by the way, now. Just FYI.
Yeah. So I'm not picking it up yet. So sorry about that. It's not. That doesn't mean it won't happen. It's just it's not quite on my radar screen yet.
Okay, that's fair. All right, let's go on now to Guy Sarandulo. Guy, good to see you, my friend. What's up?
Hey, George. How are you? Yeah, first off, I want to say best of luck on your launch next week. Wishing you success. And so I'll reiterate some of the stuff I've said in prior rooms. Last couple of times I started off, by saying, this whole market is a disaster. Just emphasizing the bearish stance that I have. But I said, I'm not going to use the same word again. Let me just find the synonym. And the first one that popped up was catastrophe. And I said, oh crap, that's exactly what I want to use. So for me, this is just a catastrophe unraveling. I don't get street research like I did when I was at Fido or Wellington, but from little tidbits I see and hear, some technicians or many were looking for a test of the June lows, a test here, a test there. But I don't see a test. I see a significant undercut. I think this next move down is going to be a big undercut of that low. And, maybe we'll get a rally of some sort. But all the money flow unit work that I do, which is very unique, and I don't really need to get into it here, but these targets I get were in place since February. So for Q1, it's just a way of measuring flow based on price analysis on monthly and weekly time frames. And that level comes down to an MFU3 comes down at 3,029. I think that gentleman from London said something about 3,000 would be, I guess, a worst case scenario for a downside. But that's where things are looking like to me on the S&P. And then, people should just take a look at a weekly chart of Amazon. This is what we call as technicians a classic distributive top in place. You have this whole month, from July to January or so, the stock really wasn't doing much of anything. They're going sideways and creating this distributive pattern. Then we get the big break, April low, and this rally we just had into July was just at the underbelly of the top. So, the S&P looks like that. Amazon is, just something that's going to break this the June lows from what I could see. So if you flip these charts upside down, which is something I did when I was at Fidelity to emphasize a point of how bearish your stock looked, I would flip a chart upside down and say, would you be a buyer of that? If you would be, then this is what it looks like, the right way, and you should be selling it. And I got a number of people there to sell paper stocks. It was in the 90s. So what I really like a lot, and again, not to really tell people what to do, but the SQQs, the measurements I get in terms of this money flow unit work, it's not Elliott wave or whatever, it's something totally different. Gets an upward target in the 68 area, which is really significant, lines up with the highs that we had earlier in the year. So that's my biggest bet. I know Mike Belkin talked about the dollar a little while ago. I have more of a bullish stance. I think the work that I've done and I've talked about in my pieces going back a number of months, 109.50 was the initial target. We were going to get a pause. And now that, in my note I just wrote this week, once we get above 111, that opens the upside to the next longer term target, which is 121. So I think the bias there has to be more constructive. And then, George, I think one of the spaces in the past I talked about the dollar yen. You just mentioned it now, and I brought up my weekly chart. I mean, I don't know how we get here, but the way things are lining up on the longer term monthly chart is 155 to 157, which is roughly the 1990 highs in dollar yen. So what causes it to get there? That's not, I'm not telling you how. I'm just telling you what I see. So, and actually, I'll just let people know that in my Twitter space, I don't do a lot of posting, so I need to get stuff out to clients first. But I did put the long-term chart of the S&P on there for people to view. I do have the 10-year there as well, something I did yesterday, just for people to view.
So just for everyone who doesn't know, Guy, former colleague of mine from my Fidelity days. We also worked together for a while. On my second hedge fund, guys, always got a kick on to tell him to speak up more. He's soft-spoken, but tremendous moneymaker, and I urge you, all of you, to follow him. he's got a rather select institutional clientele that he provides research to. So, but Guy, let me ask you this.
Sure.
You're negative on the markets. So obviously, for average individual investor, you'd probably tell them to stay in cash, or as you mentioned, triple Qs. Is triple Qs is that the weapon of choice on the downside for you, just because it's liquid and it's a triple levered ETF, or do you actually think technology is going to be the worst part of the sector in the market? Or if not, what do you think? What sectors do you think are going to go down the most in a down market?
Yeah, for me, it is, Amazon, I think, has potentially downside to roughly $70, which is about 40% from here, and it being a big weight in the Qs. And look at Microsoft's already dripping lower, day by day, week by week. So, yeah, the S triple Qs would be high in my list. And I've been, 99% of my work is trying to help hedge fund managers find shorts. But that's, I should say probably 80%. I still have my Fidelity and Wellington former colleagues as clients. So there are some longs I have to put out, but everything consumer related. So the home builders, I think I put out probably 4 or 5 shorts today, only because there were some that were not. They were actually down when the market was lifting, and some of the peer group were on the green side. So, that saying, kick them in the knees when they're weak. So I look for stocks that are not rallying in a strong tape, whether it be one day or a few days, but consumer related and software have been the biggest short bets. But there's a smattering here and there of a lot of things. But for me, I think the S triple Qs look great, and I would focus on that. And I just feel bad. It's just so many individuals are just trapped long. They buy and hold, and we've been we've been on that side of the pond before, George, where it's a relative bet, right? And I've worked with PMs that the market's down 30%, but they were down 20%, and they still get these big checks. It just doesn't make sense. But anyway, those are my thoughts.
Thanks, Guy. And please,
of course,
everyone. People really would like to hear what you have to say, so it's great when you come in these rooms and have the time.
Sure.
All right, let's go now. I think probably be the last speaker. I'll finish up, but Axel Merck, the floor is yours. Good to see you. What's up, my friend?
Thank you, and I'm trolling you guys a little bit. Great space. I just want to chime in a little bit on the sovereign default and the dollar. Put that just into my framework. The way I look at it, Japan having trouble certainly would get the Fed to pivot, but I would like to caution that a smaller EM country might not, and that might just be a blip. That said, if we're looking for ways that the Fed could pivot, one of the things to monitor are the swap lines that the Fed has, and it's been minimal of late, since the COVID peak in the crisis. So if that were to pick up for whatever reason, that to me would be a major shift. Now, some people are suggesting that maybe they'll try to patch up the rest of the world while they're still trying to fight inflation at home. But if nothing else, if and when the swap lines get activated, that might finally be the secular turning point in the dollar, that we're moving back to a reflationary world. And then depending on the type of crisis it is, it might also more domestically be that that we're pivoting. If nothing else, it sets the theme that we've gone kind of beyond the hawkish phase if we see that. I'll stop here.
Thanks very much, Axel. All right, we've been at this for 2.5 hours. I was told a few months ago I got to keep the spaces shorter, so I've been trying really hard to keep them to an hour and a half or more. But you guys are the problem. It's just such good spaces. I can't get enough of it. But I think at 2.5 hours, it's not a bad start, having been away for a couple of weeks. So with that, we're going to bring this room to a close. It's been phenomenal. We're going to do this again before too long. You will not believe, as good as some of these rooms have been, you're not going to believe some of the speakers I've got lined up. So I'm really fired up about it. Stay tuned and stay out of trouble. And see you all in the next room. Take care, everyone. Good night.
Thanks, George. Bye.
Good night. Bye-bye.
Thanks, George.